Well, what were you trying to spell? Weekend the singer or weekend the 2 days coming up?
I'm going to do both. I'm going to do the weekend, and I'm just going to go back and listen to what he's doing with Elangelo.
Where's this going?
It's not. It's just,
assume it's going somewhere.
There was a punchline
I
somewhere.
like the idea that people are listening in London and in the Friday evening in Asia.
That one guy.
In a car.
Okay, on a radio. Down 11 on the S&P. We're negative 0.25%. Bond yield's going nowhere either. 133.61 on 10s this morning. Let's go through it together. Lisa, the 10-year today, 133.61.
Yeah.
If I look at the 10-year last Friday, where were we? 134. The Friday before that,
huge move.
132.
It's been
pretty stable. Every Friday of September so far, going into the Fed next week.
Okay, this is why I watch at 4:30 p.m. on Thursdays the Fed balance sheet. No, this is important. For 3 months, they bought almost $400 billion of U.S. bonds. I mean, again, you think about where the stabilization comes from. I don't know. Could be one place to look.
The Federal Reserve balance sheet is due out 4:30 Eastern. If you've got nothing to do on Thursday evenings. Futures down 10, negative 0.2%. This was one heck of an A block. I mean, I talked about bottling some of yesterday's show. This one's special. Wow. From New York, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. A new survey suggests the Fed will hint next week that it's moving towards scaling back bond purchases. Economists surveyed by Bloomberg say a formal announcement will come in November. They also predict the Fed will hold interest rates near zero through 2022. China is trying to soothe market anxiety caused by Evergrande's debt crisis and concern over end of the quarter funding needs. The People's Bank of China has injected $14 billion of short-term cash into the financial system. That's the most since February. North Korea's work at a uranium enrichment facility is seen as another sign Kim Jong-un is removing self-imposed constraints on his atomic weapons program. That's according to 2 reports based on satellite imagery. The reports say the enrichment plant has been expanded in recent weeks. It's the worst stretch of performances for the British retail sector in at least 25 years. Sales unexpectedly fell in August for the 4th month in a row, down 0.9% from July. That suggests a resurgence of coronavirus cases and supply disruptions in the UK are taking a toll. And Invesco is a major player in an active investment management, but it could become an exchange-traded fund behemoth. According to the Wall Street Journal, the firm is in talks with State Street's asset management arm about a possible combination. The existence of discussions indicates that for even the biggest mutual fund managers, passive investing with vehicles like low-cost ETFs is the future. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I want to ask about your experience as a young woman and as a woman working in this sector, and of course having that amount of scrutiny and public attention on you. South Korea doesn't have a very good record when it comes to gender relations, the wage gap, treatment of women. Did you have a personal experience of that deficit?
I was in a mechanical engineering department for 10 years for my undergrad and PhD. Of course, I was just 2 girls among the 120 classmates in the mechanical engineering department. And then at the time, our workshop building, we even didn't have a female bathroom. So when I watched the Hidden Figures, that was so sympathizing with my experience, because I should go all the way to the campus to go to the female bathroom out of the building. But I really want to see the tendency of the development rather than the current status.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
There is no regional divide separating the interests of our Atlantic and our Pacific partners. This partnership with Australia and the United Kingdom is a signal that we're committed to working with our allies and partners, including in Europe. We look forward to continued close cooperation with NATO, with the European Union, and others in this endeavor. France, in particular, is a vital partner.
France in particular is very upset. That was Antony Blinken, the US Secretary of State, from New York City this morning. Good morning, alongside Tom Keene and Lisa Bramford. I'm Jonathan Ferro. This Friday morning, as we inch closer towards the weekend, here's the price action. Down 8 on the S&P, negative 0.2% on the S&P 500. Bonds go nowhere. Put that in a headline. 133.61. Yields doing nothing. In the FX market, the euro doing something, just a little bit stronger. Euro dollar positive, a little bit more than 0.1% at 117.81. This from Axios overnight into this morning, Tom. The president failing to persuade Senator Manchin on a $3.5 trillion spending bill. The talks ongoing.
Hans Nichols moving the story forward there is a very terse article by Hans, and really speaks to the tension of the moment. Here's what we're going to do. We got a lot of distractions, including submarines in the South China Sea. Anne-Marie Horton is distracted by the Sunday talk shows, and now we're going to manage the message into next week on this infrastructure bill and your taxes moving higher. Okay, so they meet. Manchin tells Biden to go to you-know-where. Anne-Marie, how alone is Senator Manchin? My basic take is he's not that alone.
He's not that alone. Alongside him, and who also met with the president on Wednesday separately, is Kyrsten Sinema of Arizona. She also is not comfortable with $3.5 trillion. We don't know what her number is, but there is reporting that she is keeping her own spreadsheets. Also reporting that there are back channels between House moderates, between these two senators. Potentially they're going to coalesce on what they agree on to try to push something through. But what Axios is saying is that Biden at the moment was unable to convince Manchin of $3.5 trillion. And yesterday's speech in the East Room, I was there, it was obvious this was not just a speech to the American people. This was to the president's own party.
Anne-Marie, you have so taken the Kool-Aid talking about back channels. I mean, we have back channels at surveillance, but back channels inside the Beltway. The back channels are 3 Congress people, Case, Murphy, O'Halloran. I'm focused on Murphy. But this Blue Dog Coalition, I'm sorry, Anne-Marie, isn't that going to be the story of the Sunday talk shows and into next week, that the House has some moderates that really aren't happy?
The House does have moderates that really aren't happy, but at the end of the day, the House was able to get the committees to sign on board. Doesn't mean the progressives liked all of it, but it went to a budget, and now it's really going to be the Senate to do those markups. I think the one thing to focus on when you look at the moderates in the House is, of course, there's still no agreement yet or when this will happen, where it will be in legislation in terms of salt taxes. And the Senate also, there's a lot of differences of opinion in the Senate as well when it comes to the moderate and progressives, especially on taxes, when it comes to things like inheritance tax. But yeah, this will be a big topic for the Sunday show because, of course, the president is really trying to drive home $3.5 trillion worth of spending to get everything he wants to get done to reinvent the economy, in his words.
Lisa, call me on back channels, please.
Well, I will send it through the what those tubes are where you can go and they just like get sucked up.
We have that. Yeah,
we have that. All right. Honestly, Anne-Marie, as Tom talks about the back channels and makes some sort of noise in the
what
background.
Year is this? Carry on, Lisa.
I don't want to know what that was, but I do want to ask you, Anne-Marie, about the internecine idea here of the likelihood the $550 billion bipartisan infrastructure bill could get torpedoed in this sort of push and pull of the $3.5 trillion plan that Manchin wants to see down to $1.5 trillion.
Well, the Axios reporting is that the president said that. What if we risk losing the bipartisan infrastructure? And Senator Manchin remained firm. What's so interesting about bipartisan infrastructure is the timing, and this is what I'm waiting to see. Speaker Pelosi had promised to bring up to those House moderates, as Tom Keene was just talking about, that by September 27th, she promises a vote on bipartisan infrastructure. But the idea is that that would mean that reconciliation was also ready by September 27th. No one thinks that's happening. So there's potential that it will still remain in this waiting in the wings, but the leadership of the Democratic Party has promised a two-prong approach. If they can't get reconciliation, it's a great question. Can they make sure they get bipartisan infrastructure? Something that every politician wants to go home and tout to their constituents.
Anne-Marie, before we let you go, the FDA is meeting to talk about boosters. The message from the administration has been, I don't know what to call it, maybe inconsistent, if not downright confusing. What are we expecting to hear today?
Yeah, I think the Washington Post opinion section today called it a Hamilton routine, to boost or not to boost. The administration's planning for it. They want those boosters, and they're ready for it to happen by next week. But we still don't have FDA approval, and it's been confusing because the Biden administration has constantly said they will follow the science. And you saw that Lancet medical journal where 2 FDA members actually said that they don't think there's enough data yet on the boosters. That meeting is happening at 8:30, and we'll get some guidance in the afternoon. We should note that whether or not this committee agrees on boosters or not doesn't mean the FDA follows it, but they usually do. But it's a great point that the administration is almost ahead of the FDA on this. We don't even have the FDA approval on this, and the administration's ready to go with a 3rd dose by next week.
You said the Biden administration had followed the science. The Biden administration had also promised something else to allies, that we were back, that America was back. So let's go through each occasion through the year so far. The United States government backed waiving vaccine patent protection before talking to allies and getting support from allies, particularly from Europe. The Europeans opened up travel. The United States did not reciprocate. We've seen that elsewhere around the United States as well, around the world as well. And now more recently, we have this spat with France, with the French saying that they weren't informed of what was about to happen with the US, the UK, and Australia as well. Anne-Marie, they said America was back. Do the allies believe them?
I don't think at the moment they believe them completely, given everything you've just outlined, especially right now. It's hitting hard for Macron and the French government. They feel completely blindsided. Even here in Washington, there's supposed to be a gala that commemorates the 240th year of the Battle of the Chesapeake. I'll have Tom Keene brief you on that in the commercial break. But they feel completely blindsided about what is going on. But David Ignatius makes a good point in his opinion piece this morning, is the fact that the French should not be surprised. Scott Morrison, the Australian Prime Minister, when he was in Paris this summer, he said these submarines are not sufficient enough, they're too expensive, but the French are saying that they were just not put on notice. They found out just hours or days before this was announced, and they feel completely left out. And you could see that also last night. Macron and Merkel dining in Paris, this was part of the discussion. So this is just another grievance that you can add to the Europeans' list with the United States, and it'll be, I'm sure, one of the agenda items when they meet in Rome for the G20.
Anne-Marie, thank you. Anne-Marie Hordan, Bloomberg Washington correspondent down in DC. TK, just a flavour there of some of the issues here. If you speak to European governments, if you see the reports, are they happier with President Biden than President Trump? Perhaps. Were their expectations higher? And are those expectations being met? At the moment, Tom, I think the answer to that is no.
Yeah, we don't have the time here to go into it, but I'm not at all surprised by what Biden did. I think he reached back across decades and reaffirmed the American presence in the South Pacific. No one should be shocked.
Equity futures down 15 on the S&P. We're negative 1/3 of 1%. Are we?
No.
Do you want to talk about that?
We'll talk on back channel, surveillance back channel.
What is a back channel?
It's a back channel is when,
Is that
you
WhatsApp?
and I have breakfast and...
You know.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Friday morning, good morning. On radio, on TV, this is Bloomberg Surveillance. Down 13 on the S&P. We decline about 1/3 of 1%. Onto the NASDAQ 100, negative 40, down 1/4 of 1%. The Russell, down 9 or 10 points, negative 0.4 of 1% there as well. That's your equity market. Switch on the board and get to the bond market. 2s, 10s and 30s, 133.45 on 10s. Last Friday, 134. The Friday before that, 132. You get the story here, don't you? Stability every single Friday of September so far, going into the September 22nd meeting for the Federal Reserve. That's the next stop for this market. 187.93 on 30s. We go nowhere. Switch up the board. Get to this quickly. Lisa's laughing. I'll be really quick here as well. Euro dollar, 117.85. German 10-year yields higher by 2 basis points, they're negative 28. There is one story out there that I think some people are finding fascinating over in Europe, Tom. The Financial Times out with a story that the ECB chief economist, Philip Lane, spoke to economists, gave them an inflation forecast outside of the published inflation forecast, which suggested that the ECB might be hiking interest rates sometime soon. The ECB hated that story so much they came out and said it was not true. And then an ECB official later on this morning came out on the record and said those inflation forecasts are set to be upgraded. You do the maths on that. Anyway, euro dollar 117.85, that's a stronger euro. This off the back of a conversation with Vasilios Giannakis yesterday in the FX market, Tom, that suggested all it would take was just a change in the probability. 0% no hikes in the ECB to maybe 10% perhaps would be enough to offer a little bit of euro strength. Is that enough for you?
Yes, that was fascinating. I thought that was well done.
Thank you, Lisa.
I mean, I actually was thinking that too.
I appreciate the moral support.
Anytime.
Tom Keene.
That was overwhelming.
In classic TV language. Back to you.
Oh, thank you. Back to you. Very good. We welcome all of you on radio and television. This is an important conversation, not to be taken lightly within the silliness of how quiet things are. And maybe this goes back to when John and I interviewed Bob Prince at Davos, and we tried to struggle with being at the zero bound. And then we moved to where we were X number of days ago with the Japan 10-year not trading. Margie Patel has seen it all. She's at Wells Fargo, and you need to lean forward and listen carefully as she discusses this odd quiet. Margie, the quiet to me signals something. We have the artificiality of negative yields. We have some new definition of the zero bound. We've got Japan and true gridlock and fixed income linked together, this odd economics to the quiet within the bond market.
Well, on the one hand, you have really all the central banks for many decades now pushing down towards the zero interest rates and very much wanting to keep them there. And on the other hand, you have inflation suddenly appearing for the first time in, really over a decade. And it seems undeniable, and it seems as if it's becoming more widespread. So it's a lull before the storm, before the Fed in particular needs to act and do something.
Well, the Fed's going to need to act and do something. Are you predicting they are? There's a lot of people out there, let's go with the ancient term inflationista, saying we will see price down, yield up. Are you managing for that outcome?
Only in the sense that in my fixed income holdings, I've gravitated over the last couple years actually to better quality because they won't be as badly impacted if we have a move up in treasury rates.
Margie, is the quiet because there really is nothing going on, or is it simply because right now the bond purchases are overwhelming market reactions, market pricing that would normally take place?
Well, yes, we have the Fed meeting. We also have the quiet before the budget resolution to raise a debt limit. That's a real hurdle. Nothing is going to happen before then. And most people, I think, are now expecting the Fed to do something in the way of tapering. And it's interesting. We all know they're going to do it, so it should all be priced in the marketplace. But when they begin to do something, it'll be interesting to see if the market has a surprise after all.
I guess, Margie, what I'm trying to ask is, what is the direct effect on markets of the $120 billion monthly bond purchases by the Federal Reserve? Is there a direct price reaction in the market as a response from this that will change directly, not from signaling, but directly when they start to reduce that amount?
Well, I think if they reduce the amount of mortgage purchases, that would be the most important factor, because I think the Fed's actions of basically just hoovering up all the mortgage securities has kept mortgage rates maybe even artificially low. So if they stop buying as many mortgages, would that cause the mortgage rate financing for homeowners to actually go up? Again, that would not be what the Fed would want to see, but they may not have a choice. So that's what I'm thinking would be something that I'm going to watch, and how the banks react to if they reduce the mortgage purchases.
Margie, one thing that we've been talking about this week on this incredibly exciting week for price action has been the incredible divergence in the potential views for the economic outlook going forward, and how that's one aspect. John keeps repeating this. Tell him where that is, and then tell him where the prices are. It's sort of unclear. How do you sort of game out this dramatic uncertainty in economic outlooks going forward when it comes to a market call?
Well, it looks as if the market itself, the economy, is very, very solid grounds. It looks as if all sectors are really moving. The only problem is higher prices for inputs and shortage of labor, and those aren't really bad problems to have. And corporations aren't over-levered, consumers aren't over-levered. So it looks like the economy is in great shape and should be able to take the market higher. It's just a question of how does it react to when the Fed begins to tippy-toe and do something for tapering.
Margie, we had on Anna Hahn of Wells Fargo the other day. I don't know if you read her literature. She's just brilliant, Yale physics, and just really gets it done. I was thunderstruck by the concision of the Wells Fargo equity team on modeling together an earnings call with multiple compression to optimism now and relative optimism out a year, if anybody can look out that far. Do you share that confidence of concision that we see off your equity desk?
I don't know if I have the confidence, but I also believe that. I think that we should see price-earnings ratios stay the same or get compressed, even though earnings are rising up. So that would leave the market still able to move ahead for those companies that have sustainable earnings. So I think that says the market should move up, even if it's more modest than we've had over the last year, and more widespread, not just a handful of stocks lately that have driven the market over the last, say, 6 months.
Is Microsoft a one-off, or do you see continued use of cash for share buyback over and above options?
Companies, I think, have way more cash than they can deploy, and it depends a little bit on what kind of a tax bill. Will that change their behavior, whether they pay dividends, buy back stock, or make acquisitions? So again, we have to see how they react, but they have lots of cash to do whatever they want.
Margie, when you came on the show earlier, you said that we have seen the death of the credit cycle as we know it, based on the response that we have seen from policymakers. And I do wonder, if that's the case, why not just invest in the absolute riskiest debt securities and then make a call on some of these interest rate sensitive stocks like Microsoft, thinking that they will be supported by these low yield policies for the foreseeable future?
Well, I think the riskiest parts of the market are priced with very, very little premium for anything to go wrong. If there's a hiccup in the economy or too much inflation or the Fed overreacts, that's a sector that will be impacted. We've had a tremendous amount of financing from the bottom tier, particularly, say, in the loan market, private equity market. Those are the weak parts. Plus, emerging markets, always my candidate for when markets start to crumble.
Can you play EM now? I mean, which way do you play EM? You mentioned the crumble word. We don't talk crumble on Friday, Margie, but go ahead.
Well, I think there's more reason to be cautious. We've seen China's growth decelerate. We've seen some cracks in the financial system with a large real estate developing firm look as if it's going to need some kind of restructuring. And that's really negative for all emerging markets, I think. And so I think that that's an area that I'm still a little cautious out. There hasn't been much risk premium. I think the U.S. still looks like the best place. We should have the growth. Also, continental Europe doesn't look bad. They should have 2 or 3% real growth, so that's not bad.
Margie, great to catch up with you. It always is. Margie Patel there, Wells Fargo Asset Management Senior Portfolio Manager. One story we have not mentioned this morning, a Wall Street Journal report yesterday evening, Tom Keene, that State Street and Invesco might combine.
Yeah.
Just bear in mind that Invesco is still digesting Oppenheimer.
Yeah.
And here we are having talks about State Street and Invesco. So market leaders Vanguard, market leaders BlackRock, you know all this, 1 and 2. And then you've got 3 and 4 potentially combining, Tom.
The Citigroup tandem, Katz and Horowitz, did terrific work on this overnight, John, and I don't get it. That's just one opinion, but I will say this. This is an active manager as a generalization, buying a passive manager as a generalization, and there's three ways this could go, and I'm not going to go into it right now. But what's so important here, John, is Citigroup estimates that the net, what we call the net clean at State Street is half a percent, 5 basis points, which is teensweets. It's amazing to see Invesco at 38 basis points and STT is a passive business at 5 basis points.
You can see how the marketing would work, though, Tom. The Qs together with SPY.
Oh, come on. It'd just be, yeah.
Together with SPY, that would be quite strong.
It'd be a synergy play. I get that. But what's fascinating here for everyone in the street, including Eaton Vance and Morgan Stanley, that takeout, is you've got an active manager, Invesco, with Oppenheimer, active manager, think Brian Levitt, et cetera. They're going to go after passive money, which is making barely anything. Why do that will be the question.
Oh, come on. This is obvious. It's basically when there's no fees, what do? You maximize scale. And this is what everybody's looking to do, especially when they go up against the behemoth that's BlackRock. What's their assets under management now? $9 trillion, something like that? I mean, you're looking at this, and there is no other game other than just to have a massive scale.
I totally agree.
Yeah.
They go, and Citigroup says they go down to a blended from 38 basis points down to 15 basis points with the 5 basis point acquisition. John, to Lisa's point, maybe it's desperation. Look at what we saw in, what was it, Standard Life and
Aberdeen.
Killing it.
Aberdeen. Do you want to get that out?
Can you spell that for me? It's like The Weekend.
This was not the coverage I was expecting. What do you think the administration would think of this? Basically, the message is we have to get bigger. We have to get bigger.
As Lisa said, yeah.
So that we can offer something to customers with a lower price. I mean, that goes against some of the thinking that I've heard down in DC, Tom, over the last couple of months.
I think it's a buy-side business, and we say good morning to everyone on the buy-side that uses Bloomberg terminals. You know what? It's tough out there.
We say good morning to Marty Flanagan as well. It'll be great to catch up soon. Futures down 13 on the S&P, negative 1/3% from New York. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden reportedly was unable to convince Democratic Senator Joe Manchin to back his $3.5 trillion spending plan. According to the politics site Axios, the president told Manchin this week that his opposition to the size of the budget package could jeopardize the bipartisan infrastructure bill. The two men are said to have agreed to keep talking. President Biden is trying to speed up efforts to cut down greenhouse gases. He'll host a virtual discussion of climate change with world leaders. There's concern that commitments are lagging 6 weeks before a crucial United Nations summit. The White House will unveil a new goal of reducing methane emissions. China has applied to join the Asia-Pacific Trade Agreement the U.S. once pushed as a way to isolate Beijing. Donald Trump later pulled out of the deal. The Chinese have sent a formal application to New Zealand. A number of American lawmakers have expressed concern about China's effort to join. Officials in Berlin have repeatedly warned the Kremlin to stop cyber attacks that have intensified in the run-up to the German election. Two officials say the activity suggests that Russian operatives are trying to disrupt or influence the vote. The German election is seen as wide open. Moscow has repeatedly denied meddling in other people's elections. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This week on Bloomberg Green, climate impacts and mitigation. Hurricane Ida has ravaged the eastern United States, and worse storms are likely to come. What can America do to adapt?
You know, it's never too late in the sense of we can always make things worse, and doing nothing will make it worse.
From rain to drought, Arizona introduces unprecedented water rations from next year. How will that impact business and agriculture?
Tires, fertilizer, mechanics, a bunch of things are going to be shrinking, so the economy is definitely going to be impacted.
And living with a changing climate. We look at the example of Rotterdam, a city at risk of sinking into the ocean.
A lot of people think it's going to cost us a lot of space and money, and we try to show that you also can use it to work on a better city.
I'm Kaylee Lyons in New York, and don't miss Bloomberg Green this weekend on TV, Quick Take, and online.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
As we head indoors, because the weather is getting cooler, that raises the possibility that we could see a surge of cases in places that hadn't seen it in the previous weeks. That said, I'm much less worried about the Northeast compared to the Southeast, which has really been hammered by this virus, in part because of the higher vaccination coverage.
Jennifer Nuzzo there, Johns Hopkins Center for House Security senior scholar from New York City this morning. Good morning, alongside Tom Keene and Lisa Brambitz. I'm Jonathan Ferro. Friday morning, looking ahead to next week, September 22nd, the Federal Reserve decision and news conference very much in focus. 133.45 on 10s this morning. We go nowhere on treasuries. In the equity market, just a little bit softer. We're negative 12. We're down a third of 1% on the S&P. On the NASDAQ, down a quarter, down 39. Outside of that, into the FX market, euro showing just a bit of strength. We're up a tenth of 1%. Euro dollar, Tom, positive. Stronger euro, 117.79.
John, oil 72 there. American oil. Brent crude 75.30. That's a topic for Daniel Yergin later on here on Bloomberg Surveillance. Andrew Peckosh now, Johns Hopkins University, on the idea that we are nearing 2,000 deaths again per day. Andrew, I want to migrate into the weekend on what I'm reading sort of on the back channel, which is we're really beginning to see COVID-19 patients have to pick up their medical costs. This was basically a free ride for very sick people for a year and a half or whatever. How has your world changed? Because patients have to look at paying for this horrific illness.
Well, that's a little bit too far on the back end to really make a big difference. What we really want to do is focus on that population that hasn't gotten the shot yet, that is unvaccinated, that is driving
that's still topic one
here. It still is. And, we have to be more creative in terms of how we address that question, but we can't be distracted away from that main goal, which is we won't get this case numbers under control until we vaccinate more people in this country.
Doctor, is flu season already on your radar?
Absolutely. We've been watching influenza cases. There's a little bit more activity this year than we've seen over the past few years. So we really are worried that without public health interventions like we had last fall, that we're going to see a surge of flu cases, and that's going to complicate COVID-19 diagnostics. And it's also a disease that may target younger populations more because we haven't seen flu in a few years. So it's a complicating issue that we're really keeping an eye on while we keep focused on COVID-19.
All right, so Andy, as we get focused on trying to get more people vaccinated, there was some news that crossed, including the Pope urging everyone to get a COVID vaccine and the White House making a call to Nicki Minaj after her Twitter post that got a lot of attention that we wouldn't read because it wasn't really fit for morning television. Is this the way to get more people vaccinated?
We have to really go out there and aggressively go after the misinformation and the lack of information. And then we also have to find better ways to communicate to the pockets of population that are probably willing to take the vaccine, but are really just step back and see all of this noise on both sides and are just unclear as to where to go. The science is clear, the safety is clear, the efficacy is clear. Just got to get better at getting the messages delivered correctly to the right populations.
Andy, when you're talking about all the things that are clear, to your point, there's a lot that's unclear, and I think about the booster issue, in particular, the FDA meeting for an extensive period today to discuss whether to recommend boosters. Do you think that this debate is premature and muddies the water, or do you think it's important for us to be focusing on this because it will be an important tool?
Well, when it comes to boosters, the one thing that is clear is that the data on boosters say that boosters are safe and boosters do increase the amount of protective antibodies that you have in your system. So no doubt about the safety and efficacy of a booster. What's really in question is the need and the priority of individuals to get a booster. We have to think about this as boosters are going to help reduce severe disease. So if we focus on populations that are vaccinated but starting to see some more severe disease, and the over 65 population is one of those, boosters may be perfectly reasonable for that population, but boosters are not going to help reduce the number of cases in this country because that's driven not by vaccinated people, but by unvaccinated people getting infected.
Andrew, I know you're going to be at the 50-yard line for Rutgers football this weekend. That's what you do when you've got that parchment from Rutgers. College football is going to go sea to shining sea, 107,000 in Michigan. Damian Sasser of Bloomberg, folks, is going to be at Ann Arbor. Great. How do you put unvaccinated in a bowl? I mean, is that the social constraint to limit this silliness? Is unvaccinated partition or they can't attend?
Well, this is where we need to get back. In a few weeks ago, the Biden administration proposed their plan to re-up their efforts against the pandemic, and things like vaccine mandates, particularly for these kind of events that aren't essential but are really something that many people would like to go to, is a great approach. I think if you not only offered vaccines at these events, but if you said that you needed to be vaccinated before you entered, you may see people sort of move forward and get that vaccine and then realize that that's a step to get back to normalcy.
You know, John Farrow, I mean, the way this works is Dr. Pekosh sits at the 50-yard line, Delaware Rutgers, and gives Liz Ann Saunders the vaccine. I mean, that's how you do this.
What happens at a 50-yard line?
You know,
a booster.
That's football.
That's football.
Football.
No
American
idea.
football.
Doctor, I want to finish on an important line. I hear people who haven't had a vaccine say the following quite a lot. If your vaccine is so good, why do you care about whether I've had mine or not? What do you say back to them?
Well, it really goes to thinking 2, 3, 4 months down the line. If we let the virus continue to replicate in people, we're going to get more variants emerging, and some of those variants may be able to evade that vaccine immunity that is doing such a good job so far. So that's really the long-term goal. We want to protect people. We want to reduce human suffering, but as a society, reducing the number of cases is going to reduce the number of variants that come out, and that's why we still need to vaccinate people, not only here, but also think about this as a global pandemic again.
So we haven't got to a position where it's about individual risk tolerance. Doctor, we're still not there?
Absolutely not. When you look at other countries that have been on the forefront of vaccination, they've all gotten to much higher levels of their population being vaccinated, and that is where you start to see some of the greater benefits to the unvaccinated as well as society in general. We're not close to that level yet, and the more we let these variants emerge, the harder it's going to be to get to that protective level.
Doctor, we appreciate your view on things. As always, Andy Pekosh there, Johns Hopkins, Bloomberg School of Public Health professor and virologist. That was a conversation killer, wasn't it, Lisa? What happens on a 50-yard line?
Yeah, that was definitely...
Nobody knows.
Oh,
Definitely
John,
not
what
me.
you just brought up there is the heart of the matter.
I
This
agree.
goes to the virulence of the Delta variant. Maybe the new one's coming along as well. And as the pro said, we're nowhere near where we need to be.
And that's the big issue right now. I think there was a hope, Tom, that we'd got to this position where
Yes,
it was really about
absolutely.
individual risk tolerance. And Lisa, we're talking about the healthcare system and capacity being overwhelmed in certain parts of the country.
And kids that aren't able to get vaccinated yet, in addition to potentially new variants that could spur up. I love that Tom Keene was the one to pull us back onto the rails there.
That was nice, wasn't it?
That was special.
I think that's
Use
because
your
Tom
word.
doesn't know what happens on a 50-yard line.
Al was talking to me on
I
the back
certainly
channels.
What's Al saying?
Al's looking in Mayfair for something 5 bedrooms.
He's staying there. Down a third on the S&P from New York City this morning. Good morning. This is Bloomberg.
Boosters work, and they will definitely help. The boosters, both the Moderna and the Pfizer booster, take antibodies back up to at least where they were, and probably twice or 4 times where they were at the peak. It's definitely teaching your immune system to recognize Delta better. The antibodies that people are making after a booster, they are better antibodies. And they're also probably then better antibodies at recognizing other variants in the future. If you get infected once, your immune system says, all right, here's how much I want to set aside of memory, right, to not get that again. You get infected twice, your immune system says, well, that didn't work, right? It should probably up that some. You get infected 3 times, your immune system is like, all right, this is a problem. It's really worth not getting sick anymore. And so the vaccines are essentially that, right? And if the immune memory was pretty good after the second one, what's probably going to happen after the third one is that it's going to be more stable. Even if the peak is the same, you're going to keep more of it for a longer period of time. It's a race, right? It's a race between the virus and your immune system.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Growth we've had coming out of this recovery has been accelerated.
We're arguably the most expensive market in well over 100 years. The stock market is going to end the year higher than it is today, but we are in a period where I think risk is a little high then. Monetary and fiscal stimulus they're going to start to wane. That's going to be the 2022 story.
The problem may come if inflation comes at 4% next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The Great Divide on Wall Street from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market down 11 on the S&P, negative 1/4%. Going into Saturday, Sunday, Monday, Tuesday, Wednesday.
There you
go. That is Fed decision day, Tom Keene.
Stop at Sunday. Tottenham, Chelsea is what I'm looking at. John, you got to look forward to the 50-yard line or the halfway line as we get to the Fed meeting. I don't know when it is. I'll say Tuesday, and maybe the market's liven up on Tuesday betting that outcome.
And then straight on to November 3rd, Tom. Two-thirds of economists surveyed in our survey expect that to be the time when the Federal Reserve makes that call.
Before we get to Andrew and a smart conversation there, let's open it up. John, simply, is this about the lack of shift to service sector growth? Is this about another thing? Is it a third thing? Is it a fourth thing? I'm drowning in narratives.
All of the above. Let's go with point one, just briefly.
I'm at the halfway line drowning.
Service sector recovery, Tom, has been pushed back. The supply constraints were expected to start easing in a more material way this month. People are pushing that back into the back end of the year. The inflation data, Tom, a downside surprise then. That might give people just a little bit more comfort to wait, just a bit more time. That's the view from a lot of people on the street going into next week.
What about commodities?
Crude, energy prices.
All of it.
All part of
Groceries.
it. Okay, but let's think about it. What's happening in the UK right now? The wind stopped blowing, okay? The wind stopped blowing in the UK, so energy prices are up.
Blame the Fed.
Has that got anything to do with monetary policy?
No, that's idiosyncratic.
Okay.
I get it, John, but are what I'm paying for fancy pickles that are, they're not on the shelf?
I'm with you. We turned the economy off. We turned it back on again. Flushed it with a load of stimulus. There's a ton of demand. There's just an expectation, TK, that fades through to next year. I'm not going to take a view on that because it is so polarizing right now, but that's the expectation of a lot of people at these central banks.
You really see it, John, in non-store retail sales. Michael McKee gave me that yesterday. It's the Amazon chart, and it's amazing how we've boomed off the long-term trend line.
This quote from Sam Rowe over at Axios, Tommy, quotes Paul Donovan from UBS. You'll like this one. It is worth remembering such data when reading sensational stories of supply chain disruption. This is not a world of Soviet-style shortages. If goods were not getting through, retail sales would not be happening. Lisa, that's from Paul Donovan over at UBS.
Yeah, some people talking about how actually where you're seeing the faster inflation, places like the United States, it is a direct consequence and direct correlation to the checks that were sent to individuals that are being worn off. But I think Tom raises a good point about the service sector rebound. And I'm wondering the longer term consequences of the delay. You asked John, is this a recovery delayed or interrupted? And I don't know that we have that answer, and the Fed, I think, is leaning on that question to delay.
Well, let's take job openings in America, right? Sky high, tons of demand. Three options here. One, you have the supply shortage on the labor side start to ease. Over time, workers come back, great. Or two, you have to raise prices surge, wages go up. Or three, that demand is actually time sensitive. And that demand, Lisa, starts to erode. That's going to be a fear on people's radar going into next year.
Yeah, Pete Scheer actually came out with that idea that basically some of these jobs are starting to evaporate. And we're seeing restaurants shut down, limit hours because they don't have the staff. That is jobs disappearing, John.
Equity futures down 11 on the S&P. Operation Get to the Weekend in full swing here on Bloomberg Surveillance. We're down 1/4%. We are negative, just a little softer. Into the bond market, yields go nowhere, 133.95, 134 on 10s. Is exactly where 10s were this time last week. Euro dollar positive, a little more than 0.1%. Euro dollar, Lisa, 117.80.
Which is the interesting spot, as you said, as that ECB story continues to percolate. Is there a bit of disagreement among the inflation projections? Today, what I'm watching, the FDA panel is meeting throughout the day on vaccine boosters. This comes as Andrew Pekosh of Johns Hopkins was just talking. Everyone wants to just get more people vaccinated. How does the booster discussion complicate those discussions? Then at today is quadruple witching day for U.S. markets. There is a question of what this means, why this matters. It's the expiry of 4 different types of derivative contracts. And typically, it is one of the highest volume days whenever this does occur. However, does it lead to an actual decline in markets? Some people are suggesting that maybe this time it does, as some of these contracts reprice and some of that bearish overtone that we've been hearing starts to bleed a little bit more into markets. And then 10 a.m., this to me might be the most important data point of the day. Maybe not saying very much considering how we've built up this day. University of Michigan U.S. September Consumer Sentiment Survey coming out. I'm watching the 1-year inflation expectations that recently hit the highest going back to 2008, as well as the 5 to 10-year inflation expectations, which really speak to how much consumers are buying the story that the Fed is selling, which is that it is transitory and that higher inflation will fade over time, John.
Lisa, thank you. Supply constraints weighing on demand potentially for some big companies in America. Tom, we talked about Nike getting downgraded at BTIG earlier this week. My producer Jamie's shooting a couple of calls across to me this morning from the likes of UBS on 3M. We've got some downgrades there, 3M, some downgrades on FedEx, and all of this comes down to issues around supply constraints.
You have a private producer?
I have a producer for the Open at 9 o'clock Eastern Time, live on Bloomberg TV. That's the promo. Do you not have a producer, Tom?
No, I have nobody.
That might be a bit of a problem. You're there alone in that studio.
No, my entourage is in here. They get me Tang. Other than that, I get nothing.
Is it Spike Tang?
On this Friday, it is.
Sounds like it. Andrew Sliman joins us now, Morgan Stanley Investment Management Senior Portfolio Manager. Andrew, number one question in the equity market that I hear, can we get a second run at those cyclicals going into New Year? Andrew, can we?
I think so. I think we're seeing the mirror image of this spring, which was, everyone thought rates were going to 2%. The economy was strong and the bond market rolled over, cyclicals rolled over, energy prices rolled over. And now and then the economic data this summer validated that. And now we're seeing weak economic data, but rates are starting to go up. Yield curve is starting to re-steepen. The semis are breaking out to the upside. So I think the financial markets are telling the reverse of this spring, which is re-acceleration in the fourth quarter. So the answer to your question is yes.
Help me out here. I've seen more collective gloom, Andrew, in the last 6, 7, 8 days than I've seen in ages. Give me the measure on the Sliman wall of worry right now. Where's the needle this morning?
Well, I am watching the bond market, and I still say, last time I was on your show, I'll be wrong if rates go back to 1%, but I'm noticing, despite this economic data, yields are slowly creeping higher. They're north of 130, and energy prices slowly creeping higher. Yep. So that tells me that my fourth quarter thesis is not wrong, but I will be wrong if this all rolls over. So that's what I'm worried about.
Andrew, could we actually get any economic signal from bond markets that are so distorted, or distorted is perhaps the fair word, influenced by central bank buying, not only in the United States, but also overseas?
No question. Look, I think the bond, where rates are, stocks actually should be higher, in my opinion, on a valuation basis. But I think the stock market gets the gig that the Fed's been buying bonds and rates are artificially low. So I think actually the market is pricing in higher rates than this. And just to be clear, if rates go up, I'm not so sure it's great for the cap-weighted S&P, which benefits from this low-rate environment, given the fact that it's full of, these long-dated growth stocks.
So, Andrew, I hear you. You think we can get another run at these cyclicals. You think Treasury yields are starting to inflect higher. We might have seen the bottom. That's what you're suggesting this morning. Many people think, though, Andrew, that we need a catalyst similar to the one we got in early November last year when we got that efficacy data for the vaccines. Do you think we need that kind of catalyst going into year-end to get that second run?
Well, I think that you're going to see the economic data re-accelerate off the third quarter. That's kind of the view of analysts. I think that you're going to get a very good earnings season. I don't see any companies pre-announced. And, you were talking about supply constraints, but, I just was at an industrial conference and heard a lot of industrial companies say their backlogs are very strong into next year, and they're very confident about their earnings outlook. So I think, stronger economic data, stronger retail sales, maybe the COVID variant comes down a bit. You've got the makings of a good fourth quarter.
That Q4 step up, Andrew, is such a good point. TK, Michael Feroli over at JP Morgan came out yesterday morning. Downgrade to Q3, upgrade to Q4.
Yeah.
They're looking for this step up, Q3, Q4 into next year.
John, I'm so glad you mentioned this. I'm sorry, there's 47 flavors of opinions out there. I'm watching what corporations are doing. Canadian National off, Canadian Pacific just out. They say they've got ambitious value creation. That's the pixie dust I'm seeing company to company.
Andrew, wrap it up for us. Speak to that. This re-acceleration into next year. Is that what you're looking for?
Yes, and I think the opportunity set is not in the S&P. It's in all those stocks that are below the largest companies that really are off their highs because they're more cyclically exposed. I think emerging markets off a high. I would play those areas versus the market, the S&P cap weighted.
Interesting. Andrew, thank you. Andrew Sliman, Morgan Stanley Investment Management Senior Portfolio Manager. Lisa, step up, Q3, Q4. Yeah. Heard that a lot, actually. Not just from JP Morgan and Michael Feroli, but others as well.
Yeah, we have heard that from a number of people. We've heard also the opposite, that basically they've downgraded their expectations for Q4. But I think that actually the retail sales number yesterday showed the incredible willingness of American consumers to spend money, even if they cannot go out and spend on services. And that actually supports the step up that some people are predicting.
Ian Shepherdson over at Pantheon Tom came out and just said, bet against the U.S. consumer at your peril.
John, can I mention something I'm so dumb on?
Tom has firsthand knowledge.
Is it triple or quadruple or quintuple?
I've got no idea. Let's ask Kelly Vines. What do you want to call it?
I have no idea.
Don't know either.
It's called quadruple.
It's quadruple.
That's what it's called.
It's quadruple.
Quintuple.
Okay. Futures down 11 on the S&P. Negative a quarter of 1% on the S&P. From New York City this morning. Good morning. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. A new survey suggests the Fed will hint next week that it's moving towards scaling back bond purchases. Economists surveyed by Bloomberg say a formal announcement will come in November. They also predict the Fed will hold interest rates near zero through 2022. China is trying to soothe market anxiety caused by Evergrande's debt crisis and concern over end-of-the-quarter funding needs. The People's Bank of China has injected $14 billion of short-term cash into the financial system. That's the most since February. North Korea's work at a uranium enrichment facility is seen as another sign Kim Jong-un is removing self-imposed constraints on his atomic weapons program. That's according to two reports based on satellite imagery. The reports say the enrichment plant has been expanded in recent weeks. It's the worst stretch of performances for the British retail sector in at least 25 years. Sales unexpectedly fell in August for the fourth month in a row, down 0.9% from July. That suggests that a resurgence of coronavirus cases and supply disruptions in the UK are taking a toll. Finance firms that have struggled to reach young and new customers may now have found a solution. Call them finfluencers, 20-something TikTok stars who found there's big money in being a Wall Street influencer. They steer online talk about finance firms instead of beauty products or Hollywood blockbusters. One claims to be making $500,000 a year and gets some of his pay in company equity. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line.
Okay, traders, I am placing a new order to buy euro. If you're looking to trade euro, please copy this trade. I'm looking to buy at 117.795. 117.795. Here is the order I placed. Let's see what's going to happen if we will get filled the price a little bit away. So I'll wait for several minutes to see where it will move. It will move higher. I will have to cancel the order and wait for another time. Okay, guys? I'll speak to you later.
Which we Germans, during 16 years of Merkel, tended to take as forever, are evaporating before our eyes. The eternal assurance of the United States always protecting us, that's gone out with Donald Trump. The certainty that we will build an ever closer union, the EU, has gone out of the window with Brexit.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I know we still have a long way to go, but I'm confident the Congress will deliver to my desk both the bipartisan physical infrastructure plan and the Build Back Better plan that I have proposed. And I've said many times before, I believe we're at an inflection point in this country.
The President of the United States from New York City this morning. Good morning, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market shaping up as follows. Futures negative, softer, down, lower. We're down 0.25%. We're negative 11 points on the S&P. Yields going nowhere. 133.95 on 10s. And a special good morning this morning, Tom Keene, to the Abramowitz boys tuning in to Bloomberg TV and radio ahead of Mom's birthday tomorrow. So hello to the Abramowitz boys, and I hope that you've got Mom a nice card and a nice present. She was in a really bad mood this morning, kids.
Okay, traders, position opened on euro, new position 117.795. All of you guys who decided to trade with me, stay with me, follow my trades, and we will close this trade together. Stay safe.
Radio a few years back. I remember that. It was wonderful. Yeah. It was wonderful. And I know a lot of you out there want rid of me one day. So if I vacate this seat, there's someone in the running, Tom.
Okay.
We'll talk about Bitcoin a lot.
That. Lisa's taking off the next 10
I hear that he might be bullish.
He asked me to buy Bitcoin for his college education.
Okay, well, Emily Wilkins with us with Bloomberg Government. And I said, what should we talk about? And she said, go to the 50-yard line for John Farrow. And we do it with a gentleman from Ohio State, a really good football player, got injured in the NFL and picked up the pieces and went to Stanford. And he's done better than good. And Emily Wilkins, Anthony Gonzalez of Ohio, walks away. Why did this wonderful person, whatever your politics, why is he walking away from public service?
Yeah, Tom, you've hit the nail on the head here. I mean, Anthony Gonzalez, when he was recruited to run, was a dream candidate, had that Ivy League, had the NFL. He was one of the 10 Republicans who voted to impeach former President Donald Trump. And former President Donald Trump has not let him forget that. He's already endorsed a challenger for him in his primary. Trump has already come to his district in Northeast Ohio. The pressure is on, and not only, you know, when he broke this to the New York Times, Jonathan Martin last night, he told him not only is it that he's facing a difficult primary challenge, but he is seriously concerned about the future of the Republican Party, that even if he was to win his election, he's worried about what kind of policies he's going to be a part of.
I mean, Emily, this is so important. Where's the GOP to defend the gentleman from Ohio State?
I mean, look, you have heard some Republicans who definitely back Congressman Gonzalez, who want to support him. There's a kind of a thing within Congress where it's you support your incumbents, you support your own members. But there is a growing sentiment within the Republican Party that you have to pay attention to that wing of Trump supporters and to what they believe. There are a number of Republicans out there who are keeping a very close eye on their primaries, making sure that there aren't people who are going to be running to their right. And that's pushing the GOP further to the right in terms of what they're supporting, what they're saying, how they're really presenting themselves.
Lisa, scrupulous about surveillance corrections. We need to correct Emily Wilkins. Emily, Ohio State is not part of the Ivy League. Lisa?
Thank you, Tom, for that surveillance correction. There is an issue right now, and I'm glad that you're talking about the election, the 2022 election and beyond. We talk about the disagreements, Emily, within the Democratic Party. How divided right now is the Republican Party, or is it coalescing actually around that Trump base, even though a lot of members want to try to move forward?
So the Republican Party is divided right now, but it's really hard to see those divisions because when you're in the minority party, you're just against the majority, right? All of the Republicans can coalesce around their dislike of President Joe Biden and his liberal socialist, that's what they call it, socialist policies. So it's very easy right now for Republicans to present a united front, but behind the scenes, and I think Gonzalez's retirement really highlights this, there is a divide in how the Republican Party needs to go forward. And there are some serious questions about what the party is going to look like in a post-Trump era. I mean, at least for 2022, Trump's not going to be on the ballot. He's not going to be in elected position. And there's a question that Republicans are really grappling with right now as far as how much they try to cater to that part of the base that was very energized by Trump and how much they tried to win back those more moderate Republicans, those traditional conservatives, those independent voters who took one look at President Trump and what he said and what he did and said, no, thank you, and went to go and support the Democrats instead.
Emily, I want to take a step back. It's Philosophy Friday because not a lot else is going on. And I'm wondering whether this Congress has moved beyond the dysfunctionality that we saw pre-pandemic. There was a brief window where things got done. Have we moved beyond that and have things broken down? Or do we see a new functionality as there is a recognition of the need for infrastructure spending and of the support that a lot of people had for the previous spending bills?
You look at infrastructure and you do have to give them credit. That is a bipartisan bill. It is a bill that lawmakers came together on. But you look anywhere else other than that bipartisan infrastructure bill, and it's the same partisanship that we've been seeing. I mean, look at the debate right now on the debt ceiling. This is something that Democrats and Republicans were able to come together on under President Trump, but you've seen a number of Republicans hold very firm. I mean, Senator Mitch McConnell had a conversation with Treasury Secretary Janet Yellen. She's telling him, you know, he has to support this debt ceiling or else the U.S. is not going to be able to make its payments after October. And McConnell is a firm no. He's insisting that Democrats alone need to take this vote because they have control. And on something as critical as the debt ceiling, where both parties to a certain extent know that they must raise it or they must find a way to extend it, and Republicans are just holding firm. Things are still very partisan here in D.C. We're only expecting to see that partisanship heat up the closer we get to the 2022 election.
Emily, thank you. Emily Wilkins of Bloomberg Government down in D.C. Brian Deese talking to this morning, the director of the National Economic Council, out on a American broadcast at MSNBC, saying the following, Tom: confident the debt ceiling will be dealt with. That's the line from the National Economic Council director. Confident the debt ceiling will be dealt with.
John, another idea really important. I'd love your thoughts on this. Matthew out on Twitter has an incredible insight, which goes back to Lawrence Kudlow years ago, way before his public service. All of a sudden, John, we have to do legit, nominal, and real analysis. With this new elevated inflation, for the first time in ages, it really matters.
And we go back to some work
nominal, real analysis.
We go back to some work from a long, long time ago. Tom, about what matters. Real wage increases or nominal?
When was the last time we did this?
I think you and I probably last talked about that, I don't know, 5 years ago?
5 years ago,
perhaps?
yeah.
But what do you think ultimately matters? And I know a lot of studies have been done on this, but for many, many people, it's nominal, Tom. It's nominal. That's what matters. But maybe it's different right now because prices are going up so much.
You know, not to bore people, but the British own the high ground on this. Good morning at the LSE as well, because, John, of that brutal depression that Britain had, not only in the 30s, but even into most of the 20s, Britain is hardwired on a nominal analysis.
Who did that work? Tom Irving Fisher?
Well, Fisher in America, I would say
right?
more. I would tilt my hat to Mr. Beveridge at London. That's where the phrase comes from. When you say you're having a beverage, it's from Beveridge of London School of Economics.
This was nice. This was good. Now everyone's got to work out what was real and what wasn't.
The surveillance, we're at the 50-yard line of the show.
From New York City, we are. This is Bloomberg.
China, if you look at US taxes, how much time do you spend figuring out these big overarching themes as opposed to what happens with inflation?
There's an awful lot going on at the moment, as you say, and clearly some of the big debates at the moment are the slowing global growth picture, which we're seeing everywhere. And we're also seeing that at a time when inflation is rising and is proving pretty sticky. And to your earlier points, Francine, essentially the interplay between those two is critical. So some of those news events this week, whether it's OPEC and what's happening from a supply perspective, is going to be crucial, or indeed, of course, that US CPI print. So we've spent a lot of time thinking about inflation more recently, because clearly that leads into when we feel you may start to see the taper and when you might start to see rates going back up, particularly in the US. I mean, what might be useful just to explain a little bit is the focus that we've seen from everybody on China. You know, clearly China, huge in terms of the global commodity cycle.
Never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
A relaxing morning so far. Good morning to you all. This Friday morning from New York City, alongside Tom Keane and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market declining just a little bit, soft and negative, lower by 1/3 on the S&P. We come in about 1/3 as well on the Nasdaq. The Russell, the small caps, down by 0.4%. The next leg in the cyclical trade, Andrew Sliman of Morgan Stanley wants to lean in. He's talking about a step up, a re-acceleration of GDP into next year. That's something to think about. Michael Feroli over at JP Morgan downgrading 3Q GDP in the last 24 hours, but upgrading 4Q. That step up and re-acceleration is something we need to talk about a little bit more on this program. Switch up the board and get to the bond market. I'll give you a flavour of things this Friday morning, going into next week for a Federal Reserve decision and news conference with Chairman Jay Powell. Yields unchanged on 10s, 133.95 on 30s, 188.41. We're up almost a basis point, or not quite. We're going nowhere on Treasuries. That's been the story through the week. 134 on 10s today, 134 on 10s last Friday, and the range of outcomes wide into next year. We've been talking about it. We started the week by talking about job openings in America sky high. Three things can happen here. Supply issues can persist, they can ease, or demand does not remain robust, and maybe that demand is time sensitive. Once again, that's the debate. And if the range of outcomes is that wide, how predictable is Fed policy through next year anyway? And what difference does it make if they make a call to taper this month, November, December? We're talking about a couple of months here. Let's finish on this. China, the dashboard, so to speak, right now. The Chinese currency is just off the strongest levels in 3 months. The Shanghai Comp is 3% away from 6-year highs. Tom, the Shanghai Comp today advancing
it's a drawdown.
0.2%. And all of this is going on with an economy that is decelerating. All of this is going on with a regulatory regime that is totally unpredictable. And all of this is going on with a property developer, a major property developer in China, Tom, having some real issues.
Well, it is.
That's the story in China. So if you're sitting here wondering why it doesn't matter to DM right now, well, seemingly it doesn't matter that much to the Chinese currency or the benchmark index over there either, Tom.
Well, John, it's a Shuobiang in China.
What does that mean, Tom?
It's a drawdown.
A drawdown?
It's a drawdown.
Is that Mandarin for drawdown?
It is. It's Shuobiang.
That was not anything.
See, Tom, this is the problem. When you do something like that, how do we know whether that's true or not?
You just assume it's not.
You spend your whole career joking about stuff, and then you come out with that golden nugget, and I don't know if it's real. There we go.
Can I go home now?
You can. 645.56 on dollar China. That's the cross-asset price section.
Romain's going. Romain is like, why am I here?
Serious with some movers. We can do that with Romain Bostic. Good morning, Romain.
Good morning, John. I think you just summed up my whole opinion of this show sometimes. Let's take a look at what's moving out there as far as individual movers. It's actually a pretty quiet day out there. Of course, everybody's talking about this Wall Street Journal story. Invesco potentially in talks for a deal with the asset management arm of State Street. Again, this is based on Wall Street Journal reporting. Who knows if this deal is going to get done or not? You are seeing Invesco shares slightly higher here on the day. Not really seeing much with regards to State Street as well as BlackRock. Obviously, this is a thread that goes all the way back to Nelson Peltz and Tryon taking a stake in Invesco back in October of last year, as well as Janice Henderson, we should point out, pretty significant stakes in agitating for consolidation in this industry, saying that consolidation is really the only way you're going to have a formidable competitor to BlackRock and to Vanguard for that matter. Flip up the board here. A few other things moving here. Lucid Motors actually higher here for a third straight day. This stock finally starting to get a little bit of its mojo back, up about 6%, finally announcing certification of its EV vehicle, the Air. This is going to be its top-of-the-line car with a more than 500-mile range on it, should it actually come to market. But it does appear that they are on track for that. A pretty decent competitor and luxury competitor, I should say, to some of the Tesla models out there. Take-Two Interactive getting a downgrade today over at BMO, down to market perform. A lot of concerns about competition and, more importantly, a delay in some of the video game titles there. Those shares only lower here by about 1%. And keep an eye on Wynn Resorts, only down about 0.7%, but this is setting up for its 5th straight day of declines. This is now your worst performing stock in the S&P 500
China?
On a weekly. This is all based on exposure to Macau and the concerns about Chinese regulation.
Romain, thank you so much. Of course, join Romain Bostic on the Guangbi. We'll see that this afternoon at 4 p.m. They'll be covering the Chinese markets there as they go in.
Has Afterthought been teaching you Mandarin?
Yeah, she is. She's taking Mandarin.
Nice.
It's good, you know.
Clearly advancing and focused on markets. That's what we like.
That's what we like. She's also studying for the CFA at age 14, which is frightening as well. Greg Staples with us with the DWS Group. Had a fixed income for the Americas. Greg, I love your single sentence note where you talk about my worst word in finance, hope. Folks, whenever I see the word hope, H-O-P-E, I circle it because it's money going down the drain, and you are looking at the hoping of a correction. Is it going to kill us?
You know, you're absolutely right. The dirty secret is that most fixed income managers have gotten the credit bet right so far in 2021, but a lot of them haven't gotten the duration call, the interest rate call right, particularly during the second quarter rally. They got it right in the first quarter when the rates market sold off, but in the second quarter they were caught on the wrong side and many doubled down. And it's been really hard because by most fundamental models, and there are probably as many models as there are managers, the 10-year should be 20 basis points to maybe even 100 basis points higher than it is today. But since March, it really hasn't worked, and managers have been waiting for that sell-off so that they can jump in. And was it going to be CPI or was it going to be rates? Maybe next week it's the tapering announcement out of the Fed. I don't think so. I think we're stuck in this. Probably the catalyst is going to be out of Washington.
So, Greg, it's pretty boring this week in terms of market moves. We've been talking about how Treasury yields are where they were last Friday. We've been talking where everything is just a marginal reaction to anything that we get across the board. Do you see any change to that scenario for the next few months, or do you think that we're going to be in this sort of range-bound place for the foreseeable future?
I think coming out of the Fed, the answer is no, there's not going to be a catalyst there. In fact, talking about next week, this is the perfect time for him to announce tapering because things are so quiet. If he waits any longer, he runs the possibility of getting into the budget debate, or if he gets into 2022, it's going to be the election. So as far as the Fed is concerned, he's taking great care to inoculate the market and let them discount it. That's not going to be the issue. Our biggest concern is what's coming out of Washington. And you guys have covered it really, really well. Anne-Marie Horton and Emily Wilkins have covered it. We think this is going to be a bigger deal as you go deeper into October. There are two camps within the Republican side. You've talked about that, but two camps within the Democratic side as well. And the contention that's going on there could be a big deal.
Well, but
debt ceiling? I was going to say debt ceiling is a big deal too, and I can talk about that.
Well, that's actually what I was going to say. Brian Deese coming out this morning on MSNBC saying he's confident that the debt ceiling will be dealt with. Does that give you confidence?
No, I think we'll get there at the end of the day, like we have in all of the other odd years when this has popped up. But the path is going to be far, far more contentious. I mean, if you think we're going to be there, you've got to tell us how you're going to get there. There's only really two routes. There's the continuing resolution, which needs 10 Republican votes, or you suspend the filibuster, or you do it through reconciliation, which means you have to raise the debt ceiling by $3.45 trillion, which is terrible optics on top of the $3.5 trillion spending plan. And I don't think the Democrats are willing to go there. So I don't know how you get there. You will, but I don't know how you get there.
Greg, the common theme within this natural disaster, this pandemic, is a fixed income market that's completely in every way not in our textbooks, witnessed, through the zero bound across much of the world, and, in a real or a nominal yield as well. Do you assume smooth reaction functions back to normality over the next decade, or are we really setting ourselves up for some major jump conditions?
In the shorter term, it's sort of interesting. I'm a little concerned because, as I talked about earlier, a lot of managers have underperformed, and they've been stretching a little bit to try and get better returns, whether it be in liquidity or in selling gamma. And you look what's happened as a result. The VIX is really low, the move's low, the XY, which is the index of currency volatility, is low, and you worry whether there's not a coiled spring there that's waiting to react. Longer term, we're probably in a world of low and steadily low interest rates. That's more of the R-star argument and what's the natural rate of interest. And it's come down over the last 10 years, and there's no reason to think it's not going to continue to be low.
So how do you respond to inflationistas worried for significant bond price declines?
I'm not too worried about significant bond price declines. We do think that CPI could be north of 2.5% for the next year going into 2022. And I think that's what you're seeing in the TIPS market, but I think a lot of the nominal markets aren't quite prepared for that. So what you do is you stay a little bit short on duration. You do it in the short end, particularly in say 1s or 2s to 5s. 10s, 30s is a little bit more difficult. That's a strange world unto of itself, but you stay short duration in the belly of the curve. It's the best you can do right now.
Greg, thank you, sir. As always, Greg Staples there, DWS Group, Head of Fixed Income for the Americas. On a bond market, Tom, I think you just totally nailed it. Trying to understand this bond market. When you're so heavily influenced by a price insensitive buyer, point one, and point two, when it's totally unpredictable, one, what the data will do, and two, what the market will do off the back of it, how do you make a bond market call right now, TK?
I don't.
It's so difficult.
None of this is in the theory. And, we take this stuff seriously, folks. I'll go to the great Fabozzi. I mean, Frank Fabozzi defines so much of this in his work, and there's others as well. John, we need to emphasize every day we're yammering away without theoretical foundations.
Let's make it simple. We've got CPI running at 4-5%. We've got GDP where? GDP accelerating potentially into Q4.
Our last guest said we're going to see quiescent inflation, as Greenspan would say.
I've seen forecasts next year, consensus view, 4 handle through next year, and 10-year Treasuries lease at 134.
So here's my question, is what is the tolerance of policymakers to higher yields at a time where the economy is being that much more leveraged to yields remaining low? And I think that you've asked this before, John. A lot of people are asking that. Do you just look at that tolerance level? How much would yields have to rise before there would have to be some sort of massive ripple through all of these assets that are hinged on rates remaining where they are? And that determines where policymakers will want to keep things. And that, to me, really highlights why it almost doesn't matter where inflation is, because people are looking past that.
There is a belief there is an automatic stabilizer in this market, that this sell-off, if we could get it in the bond market, would be self-limiting for everything you described.
Yeah.
I think Steve Major of HSBC, Tom, is largely on board with that point of view of the world in the bond market.
Well, yeah, he is. Let's revisit that, because he published here, or was interviewed, I should say. He's still at 1%, right?
He is still at 1%, a move towards 1% on 10s. A lonely place.
Yeah.
Coming up shortly in the next hour, I think conversation of this morning, Tom, fair to say, Dan Yergin, IHS Markit, Vice Chairman, looking forward to that conversation. Crude this morning, WTI 72.15, negative 0.6%. From New York City for our audience worldwide. Heard on radio, seen on TV, Tom Keene, Lisa Abramowitz and Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden is trying to speed up efforts to cut down greenhouse gases. He'll host a virtual discussion of climate change with world leaders. There's concern that commitments are lagging 6 weeks before a crucial United Nations summit. The White House will unveil a new goal of reducing methane emissions. China has applied to join the Asia-Pacific Trade Agreement the U.S. once pushed as a way to isolate Beijing. Donald Trump later pulled out of the deal. The Chinese have sent a formal application to New Zealand. A number of American lawmakers have expressed concern about China's effort to join. Officials in Berlin have repeatedly warned the Kremlin to stop cyber attacks that have intensified in the run-up to the German election. Two officials say the activity suggests that Russian operatives are trying to disrupt or influence the vote. The German election is seen as wide open. Moscow has repeatedly denied meddling in other people's elections. The CEO of Deutsche Bank has apologized to the German finance ministry and the country's top regulators. That's after one of the bank's analysts slammed the qualifications of regulators, as well as what was described as a failed government-backed pension system. CEO Christian Saving told officials Deutsche Bank doesn't share those views. Meet the Chinese billionaire who's the world's biggest loser. He's Colin Huang, the founder of e-commerce platform Pinduoduo. This year, according to the Bloomberg Billionaires Index, Huang's fortune has dropped by $27 billion. No one's lost more. China's internet crackdown has led the American deposit receipts to fall 44% this year. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
ask about your experience as a young woman and as a woman working in this sector, and of course having that amount of scrutiny and public attention on you. South Korea doesn't have a very good record when it comes to gender relations, the wage gap, treatment of women. Did you have a personal experience of that deficit?
I was in a mechanical engineering department for 10 years for my undergrad and PhD. Of course, I was just 2 girls among the 120 classmates in the mechanical engineering department. And then at the time, our workshop building, we even didn't have a female bathroom. So when I watched the Hidden Figures, that was so sympathizing with my experience, because I should go all the way to the campus to go to the female bathroom out of the building. But I really want to see the tendency of the development rather than the current status.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Happening on the ground right now, just in terms of consumer price tolerance.
We see a strong consumer right now, and you can see that even in the early starts to back to school and back to college season that we're really pleased with. And I think if we step back and look at the quarter, we see the evidence of that strong consumer.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
That it will not begin to get better until at least into the middle part of next year. And it's still very fluid, so we're not even, we don't have a high degree of confidence on that yet.
Catch up. Great to catch up with Chuck Robbins there, Cisco chairman and CEO on supply constraints. Let's be clear here, though. Demand really decent over at Cisco. The supply constraints set to persist, though, and that's the tug of war, the tension right now into 22. From New York City this morning, good morning. Tom Keene, Lisa Brammertz, Jonathan Ferro, your equity market negative 0.2 on the S&P, Tom. We're down 10 points
I was in a fog yesterday. Did you do that interview, or did Lisa do the interview?
I did the interview. Lisa didn't show up.
Oh, okay. I just wanted to be sure on that. David Wilson with us now. We've got to get quickly through this with all that's going on in China right now. You're not on China. You're on the NASDAQ.
Absolutely. I found out yesterday, thanks to Andrew Thrasher over at Thrasher Analytics, that there's such a thing as a NASDAQ 100 X Technology Index. So, you take out the technology
stocks. Take out Amazon.
You take out a bunch more. And Amazon kind of fits into the consumer discretionary category. I mean, you take out the Microsofts and the Apples and a bunch of other companies. Yeah, you're not kidding. For the last 5 years, this X Tech Index, which, by the way, is equally weighted, has trailed the equal weighted version of the NASDAQ 100. And this year, it's only gotten worse. The last 3 days, you've seen the ratio between the X Tech Index and the NASDAQ 100 equal weighted set record lows. That's just how much technology is dominating the market here. And we should point out that if you look at the original NASDAQ 100, 56% of its weight is in tech stocks, and it's only one of 2 groups as defined by the folks over at FTSE Russell.
Very cool.
That's actually beating
technology
the
for
NASDAQ
radio
100.
is 56.3%.
Yeah, absolutely.
I did not know that.
Again, this is the industry classification benchmark. It's FTSE Russell and Dow Jones. So that's one way of looking at markets anyhow.
David Wilson, thank you so much. Too short. Ready for earnings season as it comes out ending September 30. Enda Curran with us now in Hong Kong, and this is really serious. It is about all sorts of turmoil around Evergrande right now. And our great coverage talks about the creditors, the people that own this garbage, lining up legal help. Who is assisting Evergrande? Does the government just come in and quote unquote help? Who helps the debtors here?
Well, that is the big question, Tom, in terms of how far all of this goes, how far the government allows it to go. I mean, nobody's calling a bankruptcy or total failure just yet, but at the same time, pain is expected to be inflicted. Evergrande has appointed a series of Western advisors, actually, including Houlihan Lokey, that handle Lehman Brothers, and on the one hand. And on the other hand, heading to next week, we have an interest rate payment coming up that everybody will be looking towards. We have potential homeowners or people who have bought property or wealth management products off Evergrande lining up outside of Evergrande offices looking for their payment. So there's a lot going on at the moment. It's quite fluid, and it's all coming to a head and putting pressure on the government to resolve this. And that's why people are wondering just how much pain will they allow before they step in and do some kind of a shoring up or restructuring of the company.
Enda, you touched on it there. I'd love a little bit more detail if you can. The payment schedule, the deadlines, the timeline we're working with here. What is it, Enda?
Well, the big one is, or the most pressing one, is next week, September 20th, there will be interest rate payments due. Jonathan, their own colleagues out of Beijing have written that that may not happen, and that will certainly raise questions about what happens next. Now, on the one hand, we all know that the playbook here is the authorities don't want a major liquidity crisis or anything like that. They put in a net 14 billion, by the way, into the money markets today through the central bank. There's some seasonal demand there, but it was also seen as a deliberate play to keep things calm on the Evergrande side of things. But on the other hand, there is a question of tackling moral hazard. That's been a core theme of President Xi Jinping's government. So there's a question mark over, well, if these interest payments next week aren't met, then maybe others may not be met. And what happens with the wealth management products that are also in the sidelines that the people on the ground are protesting about. So I think next week will give us a flavour as to where we're going with this. But as I said a few moments ago, there's a feeling that this is all coming to a head now, and it has to reach some kind of a resolution because it's weighing on the economy in a way that the broader regulatory crackdown cannot.
And I was reading a story of yours that you worked on with the team over in Hong Kong. Just how big Evergrande debt is as a proportion of the overall high yield market in China. Just how big is this story, Enda?
Well, I mean, on so many levels, it's the big whale in the credit markets in China, Jonathan, that you refer to. It has an outsized role in the real estate market, and real estate itself makes up about 30% of the economy, different estimates on it, but it's a big key player in all of that. It's the world's most indebted property developer. There's 300 billion worth of liabilities there. So these are all serious figures, and it's going to take a long time to work all of this out. The key thing to keep an eye on, that when people game this scenario and we talk to them, is the inventory. They have about 1.3 million homes that they've promised to build and sell to people, and there's a thinking that if they have to force sell that inventory onto the market, it's going to deflate the prices of real estate for everybody else, obviously, as we know. And that, in turn, has a big knock-on wealth effect in a market where, home ownership is seen as something of a touchstone. So the inventory is a key metric to watch, just as along with the other interest payments and everything else.
And this was seeming to be the takeaway from analyst reports on this issue, that it's unlikely to see a Lehman-style event, some sort of catastrophic cascade of an insolvency causing future insolvencies. However, there was an understated risk of a more protracted and severe slowdown in economic growth in China as a result of this affair. Can you talk a little bit about that?
Yeah, so this goes to the moral hazard story, first of all. I mean, remember we've had Baoshang Bank, we've had Huarong earlier this year, a bad bank in China, one of the 4 big bad banks, and the thinking was, wow, this could be a big credit event that might fail, and the government stepped in to kind of shore it up and restructure it. And that's what's going on again with Evergrande. There's a feeling, wait a minute, they're looking at this now at a time when the broader economy is slowing down. We know what's happening with the retail side of things, and we know what's going on because of the COVID story. And on the other hand, you've got this big regulatory crackdown that's just starting that people are trying to get their heads around. And over here, you've got Evergrande, and people are saying, are they really going to allow Evergrande to fall over into an economy like that? And I think that's why people say, no, maybe not a total failure, but it's a question of what exactly will they do with it? How much pain will they enforce on investors? How much will they push the moral hazard line? And that's why there's such a big question mark around this. There will be some spillover, no doubt about it, Lisa. It will hurt the real estate market. That will hurt the broader economy. But the assumption is that the authorities will let it go to a point, but only so far before they will step in and make sure that there isn't a broader systemic event linked to Evergrande. They certainly don't want a Lehman moment in China.
Ender, thank you, sir. Just great to catch up on a Friday evening with you over in Hong Kong. We appreciate your time, as always. Enjoy the weekend. Ender Curran there, author of a great piece, joint author of a great piece out on the Bloomberg today. China's nightmare Evergrande scenario is an uncontrolled crash. This is the number I was looking for. It's in the article. 16% of outstanding notes. Evergrande accounts for 16% of outstanding notes
I did not know
in China's high-yield dollar bond market. It is the largest high-yield dollar bond issuer in China. Tom, those numbers are huge.
I've heard anecdotally, John, from family members over there, there's no other issue in China but the empty real estate.
Equity futures this morning down 10 on S&P. We're negative 0.2% into the bond market. Yields unchanged at 134.46, up almost a basis point. Heard on radio, seen on TV for our audience worldwide. This is Bloomberg.
There is just a lot of demand right now for products, whether those be items for our home office or for backyard entertainment. This has been a consistent issue for the past year or so throughout various lockdowns. The global supply chain is made up of ships and trains and trucks, and it's designed for predictable patterns of demand, which is the exact opposite of what we have right now. A lot of uncertainty about whether certain economies are going to be open or closed based on the outbreaks that they're having. So we're just seeing a lot of confusion, a lot of chaos, and a lot of uncertainty disrupt the whole system. The auto industry is very reliant on semiconductors, these memory chips that are in basically everything we buy that has sort of an electronic component to it. And they come from certain economies in Asia like Taiwan, where they're having trouble meeting the demand. The supply chain issues are going to be around as long as you think the virus is going to be around. First or second quarter of 2022 is when a lot of people see the normalizing of all the shipping and transportation disruptions that we're seeing. But if they don't, we might be dealing with this for another year or two or three.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases, or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The amount of growth we've had coming out of this recovery has been accelerated.
We're arguably the most expensive market in well over 100 years. The stock market is going to end the year higher than it is today, but we are in a period where I think risk is a little heightened. Monetary and fiscal stimulus they're going to start to wane. That's going to be the 2022 story.
The problem may come if inflation comes at 4% next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. We welcome all of you on radio, on television. Good morning as we get to the weekend here. John, I'm going to channel Mark Reno and Loverboy 40 years ago. Everybody's working for the weekend. And John, the theme I've noticed in the last 4 or 5 days on the show is the underestimation of the American consumer.
Is it Wednesday yet? I think that's what everyone's asking, Tom. We're all waiting for Chairman Powell and the Federal Reserve, waiting for their forecast, waiting for the evolution of the language in their statement, and wondering what comes next. And it's the what next that I think grips everyone. It always does. What's next? What's next in this cycle? What's next in this market? Can we get that re-acceleration to Q4 into 22? And can we get that second leg, that second run at those cyclical stocks?
You mentioned Michael Feroli, JP Morgan, with a more rosy Q4. Michael McKee of Bloomberg with that retail sales yesterday. John, I'm sorry, the American consumer reported this week constructively.
Ian Shepard's in a Pantheon. I mentioned this quite a couple of times in the past 24 hours. Why not do it again? Bet against the U.S. consumer at your peril.
Yeah.
That was his line. And look, I want to be clear about a couple of things on that retail sales print. Better than expected, but once again, that was 2 this week. Big downside surprise over in China, big upside surprise in the United States. What do those 2 things have in common? We are really struggling to get a read on where the economy is going, Tom, and still in September, middle of September of 2021, struggling to gauge where the economy is for any given data point.
And part of consumption, Lisa Abramowitz, is simply rental and housing, OER and all this other mumbo jumbo. You and I see it here in New York. I assume it's across this great nation, and that is rents higher.
Although not if you look at the CPI print from the Federal Reserve, which included basically a 0.3% rise. But if you look at any other survey, it's talking 10, 15% increases in rents in various cities across the nation. And frankly, on average, you're seeing the fastest pace of rent increases in a long time. Look, I think that this actually dovetails really nicely. The American consumer wants to buy stuff. We saw that from that retail print. However, the prices are going up, and the prices of what they want to buy are going up. And some of this is just supply chain constraints, and some of this is because they all want to buy these goods at a time when there is somewhat of a mismatch with services. At what point does this actually call the Fed's hand, Tom?
You know, it's going to be interesting to see here as well. We got a whole set of things, rather, I should say, to talk about to set up this hour. And John, you know, you mentioned the joke of getting to the weekend. Politically, we get to the Sunday talk shows, and then we stagger again to that Fed meeting.
We still haven't settled the fiscal side of things, Tom. Axios reporting
totally agree.
The President of the United States struggling to convince Senator Manchin to come around to the view that we need a $3.5 trillion package down in D.C.
That went well.
Look, we've been talking about the range of outcomes. Doug Cass weighed in on that earlier this week. Tom, they're incredibly wide, both for monetary policy and for fiscal as well. Really still quite wide and perhaps underappreciated going into 22.
You know, maybe they should have had the beer outside there. You know, the beer that Obama had years ago out on the White House lawn. Biden and Manchin with a big timber porter out, a West Virginia beer to keep everybody famous. Let's do the data now, John. I want to go through this quickly. I'm going to note Brent crude 75.34. Daniel Yergin with us later.
Yields go nowhere. 134.12 on 10s. 134 last Friday too. I think 132 on the first Friday of September. Into the FX market. Euro dollar 117.85, positive there. Some strength for the euro. Euro dollar positive, a little more than 0.1%. And futures a little soggy, Tom. Softer by 0.2%. We're basically flat on the week on the S&P 500.
Good way to summarize on Friday here. Mark Howard joins from BNP Paribas with a wonderfully holistic view. And this across the caution I've seen from the French bank over the last decade or so in measurement of GDP. Mark Howard, how does your team measure our economic growth right now?
Good morning, Tom and team. I think we see a
pullback, obviously, in Q3, and perhaps not as rosy a Q4 as some others that you've quoted, but certainly a very, very fulsome above-trend growth outlook for 2022, which is going to, support calls for taper and ultimately higher rates in 2023.
Let's build on that then, Mark. The reacceleration that some economists are looking for, Q3 to Q4. Would you agree with that?
I think it's a leveling. You were just framing a very interesting set of issues around housing, and it's not just higher rents and higher home prices, it's actually availability, which is holding back jobs and the ability of firms to hire people in many locations because there just isn't affordable housing for people to migrate to go to those jobs. So I think that's an example. Sure, the consumer is really robust and will stay supportive, but there are also issues affecting consumer demand, whether it's availability of cars or homes, as I just mentioned, or also meaningfully higher prices due to input costs coming in from all these shortages abroad.
So, Mark, you're expecting more volatility, and like others out there, you're looking at that as a potential buying opportunity to add to some of the positions that you like. How are you remaining nimble heading into a period of increasing uncertainty?
Right. Well, with the constructive intermediate term outlook that I just framed, it's important, and it's what we hear from clients all the time. You don't want to let go of your good assets. You don't want to sell, create a taxable event, and risk not being able to repurchase, whether it's equities or high yield bonds or other structured products that you may want. So it's important to add some hedges in the areas where you've had the biggest outperformance. So you've had Greg Battle on before. Greg would tell you that there are certain equity hedges that we like, particularly around some of the sectors that have been most robust. And you can use a variety of structures or derivatives to achieve that. And same in the ETF market. So I think it's being very thoughtful about where you see incremental dispersion, whether it's in the equity market or pullbacks in the fixed income markets, and putting on tactical hedges, and the ETF market is one of the ways that people do it.
Mark, this dovetails perfectly into the fact that today is quadruple witching day. Some people debate whether it matters. However, we are seeing a rolling over of all of these derivative contracts at a time when people are turning increasingly to these derivatives in order to hedge, in order to become nimble. Do you expect that today's quadruple witching will matter?
Well, it certainly matters, and it's driven some activity in the run-up to it, for sure, in equity indices and also in the credit market. So, yes, it matters. I don't think it's going to create a whole flurry of activity or surprises, but it's certainly a focal point for clients, as you said.
Mark Howard, I want to go back to hedging, and I want to do it with the heritage of BNP Paribas. One of my first meetings in Beijing was with your team a million years ago. I think it was 3 or 4 governments ago, to be honest. You guys know EM, and you know the Pacific Rim with the French heritage there as well. How do you hedge EM? Do you hedge through currency? Do you hedge through stability? Or are you hedging a soup of Greek letters? How do you actually do what we're supposed to do?
Right. Well, you've spoken to my good friend George Sun on several occasions, who's a real expert on China, and particularly around hedges for Chinese assets. You were talking about Evergrande before and the potential knock-ons that Endo was highlighting. So there are a variety of ways. Currencies have historically been the most efficient and the cleanest way to hedge EM exposures, both at a portfolio level and at an individual holding level. But there are also sub-indices that you can use to deploy, and commodities. As you know, many EM economies are commodity driven. And so, for example, you've seen natural gas go through the roof, and you've seen iron ore fall through the floor. So you can have specific hedges on those different commodities that can help protect your EM exposures.
Mark, good to catch up. As always, enjoy the weekend.
Mark, thank you.
It's the road to Wednesday, September 22nd. Mark Howard there, BNP Paribas Senior Multi-Asset Specialist. Do you want to take it on the road, Tom?
Well, I guess we're going to. Let's talk about that briefly here. Maybe they're going to pull off a Davos.
Do you want to do a Davos? Is that what you wanted to bring up? You've wanted to go there all morning.
No, it's a road show. Come on, it's a road show.
You want to go to Davos, Switzerland in January?
We talked to a lot of smart people there.
We
talked to a lot of smart people there.
And
are we bringing Lisa this time?
There's no discussion.
So.
We have to.
I hope so. And Lisa's going to experience the 2 very different experiences that you and I have in Davos.
Didn't I hear someone slipping on ice and there was the bar incident.
That was actually me and not Tom.
Conflating the two.
Sorry,
conflating the slipping on ice.
I'm sure our listeners would think that was Tom, but actually, fair enough, that was me. Futures down 0.2 on the S&P. We're negative 8 on the S&P 500. Yields unchanged. 134 is basically where we were last Friday. The Friday before that, we've gone nowhere since Chairman Powell spoke.
This day has been your worst day of data checks
in
ever.
Jackson Hole, Wyoming. Because of me, Tom, or because of the data itself?
The data itself. I mean, it's just deadly. I mean, you know, what do you do?
Euro a little bit positive, stronger, 117.82. Lisa, just bottom line, not much going on until we get to Wednesday.
No, and I wonder why. Because we actually have gotten data that is somewhat predictive, but ultimately everyone's saying you got to look past that to the next print. And that's the story. It's that it's a market of faith, not actuality at this point.
Lisa Bramage, Tom Keene, Jonathan Ferro, a market of faith. Your S&P down 7. Isn't every equity market's a market of faith, isn't it?
Well, but this bond market, what is it? I just don't understand what it's reflecting, right? I mean, we had Andrew Sliman on before, and he was saying, look at the bond market. It's his guide. What's the bond market saying right now?
My first chart of the week, the 30-year inflation-adjusted yield is over 4 standard deviations off trend. That's all you got to know. We're in uncharted territory.
What was that voice? What was that voice?
I don't know.
He's like, what? Me?
Who,
me?
Tom will get serious in about 5 minutes, and I'll tell you why, because next on the show is Dan Yergin, IHS Market Vice Chairman, on this commodity market, on geopolitics, this global economy. Looking forward to that. We're down 7 on the S&P. A beautiful city of London for our audience on TV. For our audience on radio, just trust me. You can trust one of us. Tom Keene. Yeah. Lisa Brown, it's Jonathan Ferro.
Hey.
This is Bloomberg.
With the First Word News, I'm Rishka Gupta. A new survey suggests the Fed will hint next week that it's moving towards scaling back bond purchases. Economists surveyed by Bloomberg say a formal announcement will come in November. They also predict the Fed will hold interest rates near zero through 2022. China is trying to soothe market anxiety caused by Evergrande's debt crisis and concern over end-of-the-quarter funding needs. The People's Bank of China has injected $14 billion of short-term cash into the financial system. That's the most since February. North Korea's work at a uranium enrichment facility is seen as another sign Kim Jong-un is removing self-imposed constraints on his atomic weapons program. That's according to 2 reports based on satellite imagery. The reports say the enrichment plant has been expanded in recent weeks. JP Morgan will take the first step in its plans to expand its consumer business overseas. The firm will launch a digital retail bank in the UK next week. The operation will be called Chase and will be online only. Chase will have about 600 employees. There are roughly 19,000 employees in JP Morgan's existing unit, which centers on the investment bank. And finance firms that have struggled to reach young and new customers may now have a solution. Call them finfluencers, 20-something TikTok stars who found there's big money in being a Wall Street influencer. They steer online talk about finance firms instead of beauty products and Hollywood blockbusters. One claims to be making $500,000 a year and gets some of his pay in company equity. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Here's the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
There is wide disagreement on whether we've seen the worst of the Delta variant in terms of the upsurge in cases. Where do you fall on that?
So I see that the curve is continuing to go up, which is worrying. What is making me really nervous today is that there is this accompanying surge in deaths as well.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
For a long time, this economy has worked great for those at the very top. While ordinary, hardworking Americans, the people who built this country, have been basically cut out of the deal. And I've said this from the time I announced I was going to run. I believe this is a moment of potentially great change. This is our moment to...
Bonds go nowhere, 133.95 on 10s. Into the equity market, we're down 5 points on the S&P, negative 0.1%. There has been a story through much of this week where the highs of the session have come very early in the session, and then we've sold them.
Yeah.
Sold them at the open through the first 30 minutes or so. So let's see what happens around the opening bell at 9:30 Eastern Time, live on Bloomberg TV. In the FX market, euro dollar 170.
Well done.
I mean, I assume they do it on radio too. I'm just on air on Bloomberg TV. Euro stronger by 0.1%. Get outside and we can settle this one. In the commodity market, we're down 0.6%, 72.15 on WTI. Very excited to catch up with Dan Jurgen later this hour.
Brent crude, $75 a barrel. John, I'm going to note Swiss 20 years a positive statistic. That's been a change.
German 10-year too, Tom.
Yeah,
See that this morning. Yeah, I'm with you.
Tightened up a little bit as well. We're going to get you out front of the Sunday talk shows right now. We can only do that with Henrietta Trays, with Veda Partners, Real Hill Experience, with an ear to the rail in Washington. Henrietta, good morning. I want to know the path after this failed meeting, and it doesn't matter that it's a senator from West Virginia, but how politically do you get from the convenient numbers, 2.9 trillion or 1.9 trillion, or dare I even guesstimate 900 billion? How do these guys do this and save face?
Well, I think what you start with is an understanding that in the beginning it was a $6 trillion number. We've walked it down to 4. Now it's 3.5. And at the end of the day, if it's 1.5, it's still nearly as big as the COVID relief bill that we passed the first part of this year. And it's still a tremendous sum of money. I mean, I think that what the progressives have to keep in mind is, and have to go home to their voters about, is this is still a tremendous sum of money focused on the middle and lower income communities in the United States, on children, on families, on elder care, you know, segments that are not discussed with any kind of frequency like tax cuts are generally for businesses or for individuals in particular. So I think it's all about the messaging, as you suggest, but less about the top line and more about where the money is going.
Is it going to Republican areas? It seems to me what you just described includes a lot of GOP America.
No kidding. Absolutely. Louisiana, Alabama, Mississippi, you know, that's where you see these net taker states where you have huge Medicare, Medicaid recipients, tremendous numbers of unemployed. Incidentally, the same numbers are very high with COVID and still need relief there. So I definitely think it's a disconnect between the physical location of where the recipients are and who votes for it. However, that said, obviously there are a lot of tremendous population density areas on the coast, and that's why they focus on not just the tax cuts for families, but also things like the SALT deduction and preserving maybe some of the capital gains tax cuts that they are trying to enact now.
Henrietta, you said this still is a big amount, the $1.5 trillion. However, spread out over how many years and offset by what kind of tax increase? From an economic perspective, given the likelihood of around $1.5 trillion social spending plan with offset taxes, what's the economic boost to the U.S. GDP?
Well, I think the baseline assumption from any spending is that it's going to be paid for in part by itself. So just immediately, the economic feedback that they're going to incorporate, I estimate would be somewhere in the range of about at least $600 billion. That was what was in the Ways and Means Committee, Mark, earlier this week. When we look at other studies that have been generated to deduce the estimate of a $3.5 trillion spending package, it's definitely in the $1.5 trillion plus range of economic feedback from outside think tanks. So there's going to be an economic feedback. This is not pure hard infrastructure, so it will go out faster. You know, these are tax cuts that are delivered directly through the code. So the child tax credit being expanded, you're going to see that immediately. The earned income tax credit being expanded, you'll see that immediately. It's all very plug and play. They're not trying to create new ways to get you money. There's no checks going out the door. This is all via the tax code, via infrastructure that's already in place.
Henrietta, do you think that this narrative has been somewhat lost? When we talk to analysts in the market, they talk about the tax hikes and that would actually have a pretty negative ramification on market action. Is that appropriate, or do you think that the boost could offset that for some of these companies?
Well, I think it's twofold. One, I don't think that the tax hikes are going to be anywhere near the magnitude of what the street is anticipating right now. I think the street still thinks that we're going to see $3.5 trillion in spending, which, you know, you don't have to look very far to find at least one, if not 7 senators who just will not vote for that level of spending. So if overall spending gets dropped down to 1.5, you have, let's call it $300 to $600 billion in economic feedback, a good chunk of deficit financing, and you really are looking at $300 to $600 billion in tax hikes. And as I've said in other iterations of the show, like, you can find that in the couch cushion. You know, you go after IRS audit increases to generate $120 billion right there. No change to the tax code, just making sure people pay what they owe. Section 199A expensing, eliminate that deduction that primarily benefits pass-through entities, and you've got another $178 billion. You know, you really don't have to dig too deep to offset the cost of a smaller bill, and I think that's where the disconnect lies. And the economic feedback of mostly deficit financing and assuming economic growth negates the need for tax hikes that would mitigate that growth.
Henrietta, thank you. One of the best, I think, Tom. I know you agree.
Yes.
I know Lisa does too.
Yes.
Henrietta Trace there, Veda Partners Director of Economic Policy on the What Next down in DC. Keep going back to this, the what next in the cycle. Do we re-accelerate? The what next in this market? Can we get another leg, another push higher in the cyclicals? And the what next down in DC? At the start of the year, once we got through Georgia, Tom, it really opened things up, that we could do something big down in Washington.
Well, again, Gonzales of Ohio walking away. You know, we covered that earlier.
We did something big pretty quickly.
Read his Wikipedia. The guy's bulletproof. He's like presidential candidate timber 25 years from now. He's walking away.
The now what, Tom?
Yeah.
And Tom, you've been on top of this literally since the election ended. and we started to look ahead to the midterms. Again, the closer we get to the midterms, Tom, the closer we get, the harder it gets. Is that fair to say?
Yeah, I think, where ramps up, it's an acceleration, John, and I don't know where that is. I don't know if it's October or January we all get fired up. I don't know, but, John, in my major issue this weekend is the three of us have to decide our strategic and tactical plan to be financial influencers.
Financial influencers.
This is something I'm going to study this weekend.
I've seen that story out on the Bloomberg this morning, Tom.
Are we missing something
They're making $500K a year. I've seen that. Some of them making some really, really decent money. Are you thinking of a different career?
So, are you
going to charge for content?
I don't know. It's like, do I do a cooking show? And,
No, I think you'd have to tell people why the best path forward is to stay in cash, Tom, and maybe make some food on the side at the same time.
That's it, the triple leveraged YouTube channel.
Every single meal that you prepare, you just finish by saying, stay in cash.
That's good stuff. I love it. I love
That's
it. The triple leveraged all cash channel.
I don't know if you need any qualifications to make that investment advice, but
Lisa's channel could be called the Pendulum of Gloom.
No, it's Bonds and Bears.
Bonds, Bears,
Beers, Bonds and Bears.
Yours would be, which pub are we going to?
From New York, you're right. This is Bloomberg.
Electricity subscriptions, it's a part of this new business area that we have called the clean energy services. So the purpose for this new business area is to contribute and to create this biggest movement in the world for renewable energy. We will add even more products. We have solar panels that we sell, and now we have the electricity subscription. So it really fits that ambition that we have to, within the frame of life at home, the most important place in the world, we can add more value to our customers to live more sustainably. And this is a big part of the climate positive strategy that IKEA has for 2030, that we will remove and reduce climate emissions more than we emit in our entire value chain.
Live from New York City for our audience worldwide, heard on radio, seen on TV, alongside Tom Keane and Lisa Bramvitz. I'm Jonathan Ferro. Rounding out the week with a marginal week of gains going into Friday morning. Equity futures down just 3 points on the S&P. We're negative, almost 0.1%. Going into the weekend and coming out the other side, the focus on Wednesday, this 22nd and a Fed decision, yields 133.61. The focus almost exclusively on the United States with Fed policy front and center. Got to talk a little bit more about China. Looking forward, Tom, to catching up with Wei Li of BlackRock on that a little bit later this morning. Very constructive on Chinese equity markets for a whole bunch of reasons. And Jay Pawlowski as well. I have got to say, one of the quietest rallies in global equity markets over the last couple of weeks has come out of one country, Japan.
Yeah.
The Nikkei is up more than 10% since the back end of August. That's an important lift.
This goes to the technology overlay. I'm glad you mentioned Jay Pawlowski. I'd mentioned David Stubbs of JP Morgan and a few other select ones. I thought Charles Cantor early in the week was hugely optimistic on technology and what they're doing in Asia as well. Pawlowski really strong on that. Right now in the American economy, we need a brief to try to stagger to the Fed meeting. Neil Dutta joins us with Renaissance Macro. Neil, have you adjusted your GDP guesstimate for Q3 or Q4?
You've taken down Q3 a little bit, but I've bumped up Q4. I mean, we clearly have more momentum going into the fourth quarter, whether that's, inventory rebuilding, but consumer spending, to the extent that the Delta variant is the proximate cause of any weakness in consumption. We know that that's beginning to turn around somewhat. We're seeing things like travel bookings pick up. Traffic pickup, so that's going to be good news, I think, for consumer spending in the fourth quarter.
What'd you get out of retail sales? I was overwhelmed by Amazon, like non-retail sales. I did a fancy logarithmic study. I looked at the Integrin, Neil Dutta, and all the good news of American non-retail store consumption. What did you see there, ex the challenges in automobiles?
Well, I think even if you take non-store retailers out, the number was still solid. But I think, from a macro perspective, despite Hurricane Ida, despite the spread of coronavirus, retail sales beat. And I think that's the main takeaway. So it stands to reason as these things come under more control, that there's more room for consumer spending to leap, particularly in services. Remember that food and drinking places, sort of census speak for restaurants, was flat in August. I wouldn't bet on that going forward.
Neil, you've touched on something, the heart of something that I think we need to talk about a whole lot more. It's the potential for this reacceleration through Q4 and potentially pushing that out through 22 as well. Can you frame that for us, Neil, the kind of numbers you're looking for out from Q3 to Q4 and through 22?
Well, I think we're probably hitting a dead spot in the economy in August, September. So that probably means something like maybe 3.5% growth in Q3. But I think you'll probably see something closer to 6% in the fourth quarter. And that'll give us a nice kick into 2022. I think for the full year 2022, we could see something, close to 5%. I mean, I think people underappreciate the extent to which inventories need to get rebuilt here. And, we keep hearing from factories that they're waiting on labor. Well, I think that situation is getting a little bit better, particularly because manufacturing wages are leaping, or likely to. And I think next year, you mentioned what you're seeing in the markets to open up this segment. I think next year is going to be a year of more synchronized global growth. We've had sort of disparate outcomes globally because of coronavirus, right? So you're seeing parts of Asia go back into lockdown. I don't think that's going to be as prevalent next year. I think we're going to see more synchronized global growth. That always helps manufacturing. And I think that'll take a lot of air out of the dollar. And we have a Fed meeting next week. And we know that the Fed is going to be tapering, whether that happens in November, December. But I think what's less appreciated is the fact that the Fed's response function is likely to move in a more dovish direction next year as the Biden administration packs the Fed with more dovish people. And so you have stronger global growth and a dovish Fed. That, to me, is a green light for EM equities.
That just isn't on enough people's radar, Tom, right now. That conversation that Neil's having at the moment. This idea that we could get a 5 handle next year. Just to go to the ECFC function on the Bloomberg right now, the consensus view is 4.2. And then we're talking about the synchronization that we did not get this year. Let's be clear about that. We came into this year looking for it, Tom. We did not get it. Neil now looking for that next year.
You know, nobody wants to hear this, but John, I believe in the human condition, and the number one thing I've always seen within an inherent optimism is corporations adapt and adjust. You see it this morning, Canadian National, TCI is going after Canadian National. Guess what? They're adjusting.
Neil, you mentioned the inventory build. It's been delayed, it's been pushed out. Can you put some numbers on it, Neil? Just help us understand how important that is, its contribution to GDP potentially through the next 12 months.
Well, I mean, remember, inventories over long periods of time don't really contribute much to GDP. The net contribution basically works out to a wash. But in the short run, it can contribute significant cyclical swings to growth. And you can see it, you know, maybe 3-4 percentage points in one quarter, right? I mean, so I think it could be pretty significant. One thing to look at, for example, is the ISM Customer Inventories Index. Basically, what they're doing is asking manufacturing survey purchasing managers, you know, are inventory levels too low or too high? And, you know, basically it's at a record in terms of people telling you that it's too low. So I think it can be quite substantial. And it could be, the recovery can be fairly rapid if supply chains normalize later this year, which I think should be a good baseline, particularly as the rest of the world kind of exits the current COVID lockdowns. Remember, I think the proximate cause of a lot of the issues right now is COVID.
You got to, Neil, you got to that issue, the supply chain disruptions and how quickly that'll be healed. And that's a key issue as we talk about input price inflation. This is something that I think a lot of people are watching, the idea that if people do need to rebuild their inventories, if companies need to, and the cost is going up, can they pass those costs along to consumers that are showing increasing concern about the higher consumer prices, CPI? So where do you see that gap affecting margins as a lot of people look out to peak margins and perhaps contracting margins for S&P companies going forward?
Well, I mean, I think margins will contract, I think, because margins are already at a record level, right? So there's really only one way for them to go at this point. But I think there's a big difference between a margin squeeze driven by, you know, sort of weaker productivity and one that's driven by stronger, stronger labor power, things like that. And I think that's largely the composition of this margin squeeze, I think, is probably a little bit more favorable than people are making it out to be. And remember that we have seen a significant increase in inflation already, and that really hasn't impacted, corporate profit margins. So, you know, it's important to remember that, you know, when we talk about stocks and the companies in them, the inputs for some of these companies are also outputs for many other companies, and that drives stronger revenues for those companies, many of which are traded in the capital markets, right? Sure.
The reason why I was bringing this up, Neil, is because I thought the most interesting chart of the week was from Gina Martin-Adams of Bloomberg Intelligence, pointing out the gap between PPI, the producer prices paid, and the increase, how quickly they were increasing, versus CPI. And that gap has widened out the most in years. Right. And this has been predictive of margins going forward, and it is sending a negative signal. What would you say to that in terms of a predictive feature?
I would say historically that looking at the, this is going to get a little bit technical. I don't want to sort of chart bash here, but you're looking at different universes of companies, right? The PPI index is measuring the sort of pricing power from a manufacturer to a wholesaler. So you're looking at a different universe of companies. So it's not exactly like a one-for-one thing, which is why when you line it up against profit margins, it doesn't actually work all that well historically. The margins will come down, but I don't necessarily think that that's the death knell for the equity markets. I mean, you know, as I said, they're at very high levels. But again, Lisa, I do sympathize with the idea that inflation is going to be stickier for a little bit longer, but I don't necessarily think that that's going to be something that's catastrophic for the equity markets.
I sense, Neil, you hate that word that's being thrown around, stagflation, the use of it in a period like the one we might be going into.
We're not stagnating. We're not stagnating. One of the reasons why inflation in the U.S. is firm is because demand in the U.S. is firm. Right. And it's important to remember that how COVID affects the economy. It's not, the most obvious, right, is what people talk about, no one's going out to eat, no one's booking, travel. But that's sort of a first order effect. Looking under the hood, what happens? People stay at home more, then they start to demand more durable goods. That exacerbates the supply chain issue via the demand channel. And then because everyone has to quarantine because cases are spreading, that exacerbates the production side, right? So you have fewer labor hours worked, so you can't produce as much. So you have demand moving up for durables, and you have supply moving down. And so what's going to happen when COVID comes down? The opposite will happen, right? People will start to allocate more of their dollars towards services. They'll spend a little bit less on goods. That'll give supply chains some opportunity to catch up, and production will accelerate. So as I said, I mean, I think COVID is the story here. And, you know, to Lisa's point, I mean, I think if you're an asset allocator, maybe that's a reason for you to look outside the U.S.
Neil, got to leave it there. Good to catch up, sir. As always, the wonderful Neil Dutter there of Renaissance Macro, the head of economics. I'm going to be catching up with Jay Poloski in just a moment.
Are you? I didn't know
TPW
that.
Investment Management.
He's with you, not with us.
I'll be catching up with him in about 20 minutes' time. Looking forward to doing that.
Stealing one of our guesses.
Jay Poloski, I'm pretty sure that Jay first came on the Open, Tom. But anyway, we can talk about that another time. Jay Poloski agrees with Neil Dutter, Tom, on this, and is looking to international. Is looking for this more synchronized reopening in Asia, and he likes what he sees over in Japan. And I said it at the start of this segment, I'll say it again, the rally in the Nikkei really hasn't caught many headlines at all.
Yeah, and of course we've seen it in the Pacific Rim as well, that not only on emerging market, but just on some of the nuances ex-China and all the angst over Evergrande.
Is it Saturday? Feels like Saturday, doesn't it?
I don't
and you're
know.
coming to work on a Saturday.
I think Barton Biggs introduced me to Jay Poloski. He was younger then.
How far back are we going, Tom?
We're going way back.
Way back.
It's almost
Are you
Saturday.
suggesting that I stole your
Back when
guess?
the Red Sox
I think that's
won.
where Tom's going.
I think the Heat went there right away. I think it was straightforward.
Very straight face this morning too. It's okay, Tom. We'll get through it together. I'll see you Wednesday. Tom Keane, Lisa Bramwitz, Jonathan Ferro. Lisa, enjoy your birthday.
Thank you.
A happy birthday to Bramo and to all her bears
Sell
out
the
there.
children.
Futures down 3. We're negative 0.1%. This is Bloomberg.
With the First World News, I'm Ritika Gupta. President Biden is trying to speed up efforts to cut down greenhouse gases. He'll host a virtual discussion of climate change with world leaders. There's concern that commitments are lagging 6 weeks before a crucial United Nations summit. The White House will unveil a new goal of reducing methane emissions. China has applied to join the Asia-Pacific Trade Agreement the U.S. once pushed as a way to isolate Beijing. Donald Trump later pulled out of the deal. The Chinese have sent a formal application to New Zealand. A number of American lawmakers have expressed concern about China's effort to join. Officials in Berlin have repeatedly warned the Kremlin to stop cyber attacks that have intensified in the run-up to the German election. Two officials say the activity suggests that Russian operatives are trying to disrupt or influence the vote. The German election is seen as wide open. Moscow has repeatedly denied meddling in other people's elections. Paris has become one of the hottest cities in Europe for finance professionals. Everyone from JP Morgan Chase, Goldman Sachs and Morgan Stanley to Bank of America are beefing up operations there. As a result, wages are rising and headhunters are struggling to find candidates. Since Brexit, US firms that use London as the gateway to the single market have moved to the continent. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
And doing nothing will make it worse.
From rain to drought, Arizona introduces unprecedented water rations from next year. How will that impact business and agriculture?
Tires, fertilizer, mechanics, a bunch of things are going to be shrinking, so the economy is definitely going to be impacted.
and living with a changing climate. We look at the example of Rotterdam, a city at risk of sinking into the ocean.
A lot of people think it's going to cost us a lot of space and money, and we try to show that you also can use it to work on a better city.
I'm Kaylee Lyons in New York, and don't miss Bloomberg Green this weekend on TV, Quick Take, and online.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
So recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
I would be surprised if we see $100 this year, even though we have to be prepared for everything when it comes to oil markets. The rebound is very strong. The demand we expect this year higher than 5 million barrels per day.
Fatih Birol of the IEA managing the oil message as well. Lisa Bramont and I pause now to redo my book of the year last year. We do that with the new map. I really can't say enough about it. And actually better than it was when Jürgen first released it, with a really, really important appendix on the South China Sea. Lisa will get to that here in a moment. Daniel Jürgen, congratulations with IIS. And of course, I can't say enough about the new map. Daniel, I want to rip up the script, and I want you to comment, as you did in the new map, on the entrepreneurial global reach of Elon Musk. I am blown away by SpaceX and the idea of putting 4 civilians up there. How does a guy like you, from the prize to the new map, frame Elon Musk?
I think, thank you, Tom. I think he obviously ranks as one of the greatest kind of technocratic entrepreneurs, because so much of this is about pushing the technology and doing two things, SpaceX and the Tesla. And both of them are, Tesla, of course, has really transformed the automobile industry, the whole shift towards electric vehicles, and opening the era of space tourism is amazing. It's more market driven than classic. So he's a unique figure.
Does the gloom crew that's out there, Daniel, that you fought against for decades, does the gloom crew misjudge the commanding heights of modern technology?
Well, I think they tend to underestimate how rapidly things can change. I mean, they percolate along out of sight for 10 or 15 years while people work on things, and then suddenly it becomes apparent. I mean, just to take energy, shale was 20 years in the making. It took about 40 years for solar to really come down in cost. But when it happens, it really brings big changes. And that's some of what we're seeing today.
Well, Daniel, talking about shale, there's a question of whether the death of shale or peak shale has been overstated in the aftermath of the pandemic. A lot of people saying that that was what we have been seeing in terms of the lack of getting oil production back online. Do you think that perhaps people have underestimated how quickly it could get brought back?
Well, this is an example of where you see how markets and companies adapt, because we really have seen a stabilization of shale. It's growing again. And remember, the U.S. is still the largest producer of oil and gas in the world. The nature of the industry has changed, and there's what I call a second shale revolution, which is about returning cash to investors. And so you're not seeing this, with prices where they are today. This was a few years ago, you would have seen the drilling rigs really going up in number. But now there's kind of modulation, and in general, around the world, a kind of caution about rushing into new investment. But at a time when you're seeing strong demand, either at the end of this year or early next year, we'll see world oil demand higher than it was in 2019.
So how does this undermine this whole pledge to get to net zero?
Well, I think the pledges to net zero, that's one of the themes in the epilogue, the new part of the new map, the embrace of net zero carbon by 2050. Some are trying to push it to 2030. Some say if you try too hard, you're going to have a macroeconomic shock, a serious macroeconomic shock. I think the direction is clear. How you get there in a world that still is 80% fossil fuels, the roadmap isn't clear. And the answers will really be not rhetoric, not PowerPoints, but they'll come from technology.
I'll not mince words about it, folks. The appendix to the new map is the read of the weekend. Buy the book. You can read the book in the next week, but this weekend, read the appendix as Daniel Yergin gets out front on the South China Sea. As you do, Professor Yergin, you go back in our history. You lectured at the War College. You cited Mahan. The idea of sea power is a projection. How do submarines project in the South China Sea?
This is right in the heart of the whole issue, the nuclear submarines for Australia. This is about the contest for the South China Sea. Is it an open waterway or is it Chinese territory? And the Chinese used that phrase yesterday. They talk about a Cold War mentality. This is, you're kind of seeing, in many ways, Biden has broken with Trump, but not on China policy. And indeed, he's trying to mobilize, a consortium of countries. And these nuclear submarines are exactly about the question of free passage through the South China Sea and the fact of this kind of growing polarization between China, which you see in technology, you see it in trade, and you certainly see it militarily.
So how does this complicate, Dan, the negotiations on trying to get to a greener place globally, a conversation China needs to be part of?
Absolutely. After all, China is 30% of emissions. And at the end of the Biden administration, of the Obama administration, he and Xi came to a meeting of minds, and the Chinese have adopted this 2060 goal for net zero carbon. And I'll tell you, that's reverberating throughout China in terms of what's on the topic for people. But the Chinese have said you cannot compartmentalize this. The U.S. is saying we can compartmentalize it from all the other issues. And we've seen recently the Chinese said, no, we've got to deal with the other questions as well. So I don't think it can be separated from everything else that's happening right now.
Lisa, this is like the Miss America pageant, except we're doing it with Daniel Yergin. I'm going to announce my book of the year next week. I've already hinted at it. So let's have Miss America come out one last time on last year's book of year. Dan Yergin, the new map, my book of the year last year. It is absolutely a tour de force from the prize to commanding Isaac Quest and on to the must-read, the summation of where we are right now. And again, the appendix on the South China Sea as Dan Yergin goes all Robert T. Kaplan. Professor Yergin, thank you so much. See you in Davos, perhaps, coming up. Lisa, I really can't say enough about the book. Do we need to do a data check now, Lisa?
We do, but I just want to say, I think Miss America is a misnomer. I think we have to have a Bloomberg surveillance book prince or something like that. We should have some kind of,
it's
new
been
name.
Clumsy. Yeah, we've talked about it. And, I've actually talked to John Micklethwaite, our editor-in-chief, about this, Lisa. And it's just a question of time and the crunch of doing it. I mean, what do we do? I get emails all over the world on the books to read right now.
Yeah, and do you take up all of them and read the first sentence, the last sentence?
No, I do that to some.
Down.
Some I got levels of speed read.
Yeah.
But my book of the year that I'm going to announce next week is cover to cover. I'll read every single word of it.
And just hint.
Yeah,
we
and,
just announced.
Well, I'll mention it right now. Robert T. Kaplan, 2 books, not 1, 2 books on South China Sea, Marco Polo's Return, and also Asia's Cauldron. Asia's Cauldron is fascinating. He goes right around all the countries, Lisa, right around the South China Sea.
Yeah, this is the hot spot, and this is the area that everybody is watching. And certainly when it comes to markets as well, a little bit of a downdrift in the day.
We
but
got through
not
this
very
without a
exciting.
data check. That was
Yeah,
good.
I know. So I'm trying to bring it back to the data rather than comment on South China Sea policy, which is as much a mystery right now as everything else. Yields, 1.348%.
Oh, she's looking at yields.
I'm looking
Lisa's
at yields.
looking at yields.
Shocking new development.
Futures are -5. Stay with us through the day on radio and television. This is Bloomberg.
We didn't want our story to be ended by Taliban. We wanted to continue the path that we started, to continue to go for our achievements and to go for having our dreams to reality. So that's why we decided to leave Afghanistan and go for somewhere safe. We are concerned that what will happen to our home then. Many people are leaving, but there are still girls who have dreams. There are still people who have dreams, and we want countries around the world to help Afghanistan to have peace over there, so that the girls over there can have the opportunities to continue their path as well.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
From New York City for our audience worldwide, good morning, good morning. It's a quiet end to a quiet week on the S&P 500. We're negative 4 points and down 0.1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, an uncomfortable consensus.
I wouldn't be shocked if we have a correction here. We're going to get one at some point.
Near-term, big wall of worries.
That could give us a correction.
We're going to see a little bit of a mid-cycle correction.
Markets, as you know, are really bad at mid-cycle slowdowns.
That new 2 or 3% correction should pop up.
There are a lot of risks overhanging.
We're still going to get an index level correction this fall.
A number of strategists come out over the past week articulating pullback concerns.
The catalyst for that is going to be negative earnings revision breadth.
A peak rate of change in S&P 500 EPS growth.
The rate of change on revisions is going to turn down.
Pile on top of that valuation concerns, margin discussions are starting to heat up again with supply chain and labor pressures a big point of worry, and positioning and sentiment have been stretched. Now, a lot of these things have been true for quite some time, so we've actually been worried.
We are seeing a little bit of a deceleration within the data.
In a decelerating growth environment globally.
The short-term impact is clearly through sentiment.
Sentiment is falling.
Joining us now, I'm pleased to say, is BlackRock's Wei Li, Morgan Stanley's Jim Karen, and TPW's Jay Poloski. Wei Li, I want to begin with you. Pretty much everyone on this show, 90%, who have come on this week have all said the same thing. A correction is due. We're preparing for a correction. They've also said we want to buy it. Wei Li, what's your take on that?
I think we have to understand what could lead to a correction. Here, so far I've heard second derivative slowdown on the earnings front, on the macro front. It's also possible that that ceiling debate could lead to market jitters, and it's also possible that taper discussion could lead to market nervousness. But in our view, this does not change the fundamental picture that we're still currently in an environment supported by elevated growth, supported by negative real rate. So we reiterate our pro-risk view through potential correction looking ahead.
Jay Poloski, you've been constructive. Are you still constructive?
Yeah, absolutely, John. Markdown TPW Advisory is taking the other side of this consensus. I read somewhere where 6 top tier 1 banks have all suggested a correction is imminent. I would argue we've already had a stealth correction through most of the market. For example, U.S. value is flat over the last 3 months versus the S&P up 5. So it's been a very concentrated market. Hedge funds are all long the same stocks. I think we're going to get a performance chase into year end where small caps and value cyclicals are going to outperform as the Delta fears fade and we get that synchronized global expansion that I've been talking about for some time.
I'm going to build on that, Jay. It's really important. Neil Dunter of Renaissance Macro was on the program with us earlier this morning, talking exactly the way Jay Poloski has been talking over the last couple of months. Jim Karen, we're talking about the equity market. Let's talk about the credit market. Does the same apply?
Absolutely. And I think what we try to look for is what the catalyst might be. We don't try to forecast a correction as portfolio managers, but effectively what we try to think of are the catalysts. And the catalysts that may be in front of us, it almost feels like a perfect storm. Number one, we're talking about infrastructure and really large size of infrastructure. We have to worry about the pay-fors for that. So that's debt, increased debt, potentially treasury debt, and also potentially higher taxes. That plus, and that's on the fiscal side. The monetary side, we start to think about the potential for tapering. Perhaps a policy mistake, either on the fiscal or monetary side, could be something that catalyzes a correction. And the debt ceiling, which is here now, it will eventually go away. Maybe it's the end of October, but that's also going to add more treasury supply. So if there is a correction, I think the catalyst is higher rates, and effectively that could be brought on by a large infrastructure bill with a large amount of debt issuance to pay for it, so deficit financed, and also potentially more hawkish rhetoric out of the Fed that might be premature at the moment.
There are a ton of bricks in that wall of worry. We have had bank after bank talking about an equity pullback over the last couple of weeks. Katie Lyons, you're the one who's counting. I've lost count.
All right, well, there's a long list of banks now warning for a correction, and there's an even longer list of the number of days the S&P has gone without a 5% pullback. Today, John, 219. Yes, I am always counting. And while I'm counting, it's actually been 38 days since we've seen a 1% gain on the S&P 500. And then when you take a look beneath the surface, while the S&P is only 1% off of its record high, 40% of its members are down 10% or more from their 52-week highs, and another quarter are down by at least 5%. That may be emblematic of that stealth correction that Jay Pawlowski was just talking about. All that said, volatility is still relatively subdued. The VIX and VXN are off their lows, but still not showing that much fear within the equity market on a surface level. The VIX remains at an 18 handle in that lower range we've been at throughout the summer. But some have pointed to the lack of volatility as a reason we could be seeing potential downside in the future. And finally, because it is Triple Witching Day, so it seems appropriate to talk about options, just have to talk about options activity. A lot of hedging is taking place. In fact, our colleague Elena Papina over at the MLive blog pointed out there was a point this week where you could buy one put contract for the same price as 25 calls. And what we're looking at here is open put interest on the S&P 500 now at 11 million contracts. So it tells you traders are looking for protection, John.
Kelly Lyons, thank you very much. That story's been building over the last several weeks. Seen a lot of downgrades on the economy for Q3. What about Q4? JP Morgan and Michael Ferrelli caught my eye in the past 24 hours. A downgrade to Q3, an upgrade to Q4. Here's the quote. The revision reflects a combination of weaker final demand growth and slower inventory accumulation, likely the result of the Delta virus and supply chain problems. We're revising up our projection of 4Q from 3% to 3.5%, assuming some of the normalization in stock building was expected this quarter takes place next quarter. Jay Pawlowski, I want to come to you on this. Neil Dutta of Renmac, I mentioned him a little bit earlier. He was talking about the same thing, upgrading Q4 and pushing out this better view into 22. It seems to me, and someone else mentioned this to me this morning, that everything we expected in 21, we can now expect in 22, and it's that elusive synchronized global growth story, Jay, that we did not get, that you think we will get.
Yeah, John, I would say a couple of things. First of all, we've had a lull in economic activity globally because of Delta. That's kind of kicked everything down the road a little bit. More importantly, I think we're coming out of that lull. We've had, after the Citi U.S. Economic Surprise Index was at its lows, we've had several good data points, better than expected this week. The Philly Fed, retail sales in August. The Philly Fed suggesting that supply chain concerns, which is a big issue, should start to ebb, that unfilled orders, delivery times, et cetera, all improving. As Asia reopens, that will help the global factory production process start to get back to some level of normality. So yes, I do think that synchronized global expansion is out there, but we haven't had it yet. We now have the U.S. and Europe pretty much fully reopened. We're going to get Asia starting to reopen now. And as we enter Q4 and go into 2022, we will have a synchronized global expansion. We will have Delta fears on the back foot. And I think investors, Delta has been so omnipresent that investors have really not been able to focus forward. And as they focus forward, they're going to see a lot to like. And as Kelly pointed out, we have had, without a doubt, a stealth correction in the bulk of the S&P and in most non-U.S. equity markets over the last couple of months. We're set up to go higher.
We've had a stealth rally over in Japan over the last couple of weeks on the Nikkei. Jay, you like Japan, I know you do. Hardly anybody is talking about Japan. I've tried to talk about it a little bit more through the morning. That rally's really picking up. Why is that, Jay?
Yeah, no, it's great to see because we've been long Japan for some time. As you know, John, I tend to be a little bit early, first with Europe, now with Japan. I call it a twin-engine EFA market. We had a great run by Europe. Now that's resting. Japan picking up the baton, completely under-owned. Foreigners have been net sellers. You have very attractive valuation. You have activism really picking up in Japan. You have the elections, which I think has catalyzed this latest move. We're going to see a stimulus package come out no matter who takes leadership reins in the LDP that we'll find out at the end of this month. So Japan has got a lot to like, and it's a cyclical market. When you get Asia reopening, you get that global synchronized expansion. Japan is going to be a big winner there. So it's an under-owned, large market, very attractively valued, lot to like.
Wei Li, can I get your view on that as well? This international lean that Jay Pawlowski likes, does it resonate with you?
It absolutely does. We actually also upgraded European equities and Japanese equities in our mid-year outlook, and it's good to see that Japanese equities are finally starting to move. And earlier on, you talked about some of the upgrades and downgrades in terms of kind of the growth outlook in the U.S. One thing I would say about the restart dynamics is that it's very noisy. We're talking about unprecedented restart. It's impossible to be very accurate about the forecast, but what we do know is this restart is broadening out the synchronized kind of prospects that you just spoke to. And we also do know that we shouldn't extrapolate the momentum indefinitely, both on the upside and on the downside. So as a result of everything that we just spoke to here, our equity market conviction currently sits within European equities and to a less extent in Japanese equities at the expense of US market and emerging markets.
This is the global market conversation going into next week. Let's talk about next week and bring in Michael McKee, our economics editor. Mike, really all of this is the road into the 22nd for the Federal Reserve.
Yeah, they've got to figure out what's going on with the economy, and it is definitely slowing. We can see that. You look at the number of COVID cases, and they're way up. They have sort of flattened out, but that doesn't mean that we're through this at all. And you can see what's happened there with vehicle production and with restaurants and bars in the retail sales numbers. We've seen both in this week rollover start to fall, and that is matching up with the COVID case rise. So it looks like we're definitely seeing a Delta variant impact on the economy. And we're seeing it affect the GDP forecast. You were talking about Mike Froley. This is the Atlanta Fed. We're all the way down to 3.6%. Remember, this was supposed to be the 7-8% quarter, and we're not there right now. And one of the reasons is we're seeing these cutbacks. General Motors, the latest to talk about another auto plant shut down because it can't get parts. And just a few moments ago, the folks at IHS Markit came out with a stunning forecast. They forecast auto production will be down 6.2% this month from their previous forecast and 9.3% next year. That means very few cars coming off the assembly lines and a lot less sales for the auto companies. So where does this leave us? Well, the question is, do people buy other things after that? You can see the IHS numbers right there. You mentioned Mike Froley. They changed their forecast from 7% to 5%, but raised their forecast for the fourth quarter. Goldman Sachs and Morgan Stanley sort of the opposite way. They've lowered their forecast for the fourth quarter. They think the third quarter is still hanging in there. So it's kind of pays your money, takes your choice. It's going to be slower, but it doesn't mean that all this growth will be destroyed. It'll just be distributed differently.
Mike McKee, thank you. Jim Caron of Morgan Stanley. Jim, let's pick up on that. I know the work that Ellen Zentner has done over at Morgan Stanley suggesting we might have seen the worst of it in August. What's your view now, the path forward?
Yeah, so we broadly agree that we are in a global reflation trade and that things are going to get better. It's just that we're in a troughing period. And the question for us is, how are markets actually pricing this in? Have we already priced the trough? Look, there's a lot of bad news out there. There's a lot of things to worry about. We just talked about that. Now the question is how much of that is actually priced and what are the unknowns? And some of the unknowns are still are around the infrastructure deal and how that gets paid for, debt and also taxes. But look, broadly speaking, yeah, in the third quarter, we've just seen a decent retail sales number. So we know that the Delta variant has been a headwind, but the consumer is not gone away. It's coming back. We think that some of the demand is still coming into the future. So this is really an opportunity for us to start to think about, if there is a correction, what dislocations does it create? Because I think it's a correction within a very positive market still, not just domestically, but also globally. So if we're looking at credit, we're looking at high yield. What we want to do is we want to minimize default risk at this point. We do think that interest rates are going to rise, so therefore we have to be a little bit sensitive to interest, longer duration assets with more interest rate sensitivity.
Let's build on this through the hour. Jim Caron sticking with us alongside Jay Poloski and Wei Li. Your equity market futures are negative 0.04%. That kind of captures the week, not just this morning. We've been pretty much dead flat on the week on the S&P and dead flat on Treasuries. Some chop in between, but not doing much from Friday to Friday, from point to point. 17 minutes out from the opening bell. Let's get you some movers ahead of that opening bell at the market desk. Here's Abby.
John, great points there in terms of the chop, but relatively flat on the week. And that's true for two of the biggest weightings to the major averages. I'm talking about Apple and Microsoft. Apple yesterday finishing with a small decline, now up slightly. Amazon, however, you can see up ever so slightly. This as yields are climbing once again, a little bit of a playback of yesterday, but we're not seeing the pressure on big tech like we did yesterday. We are seeing gains, though, for the big banks. JP Morgan Chase and Bank of America both climbing as the yield curve is steepening. 2-10s up about 3 basis points. Now, we just had a headline crossing about iron ore dropping below $100 per ton as China's steel cuts hammer demand. You can see that is weighing on some of the steel stocks. Nucor not trading at this point, but U.S. Steel and Cliffs Natural Resources both down on that headline, John.
Abby, thank you. Coming up on the program, President Biden amping up the pressure on fellow Democrats as division within the party continues to threat his economic agenda. That conversation is next from New York. This is Bloomberg.
After 16 years in power, actually, remains one of the most popular, if not the most popular, German politician ever. Who's the right person to fill those shoes?
Well, whoever is going to be filling those shoes is going to have a very hard time. Look, as the Merkel era ends, most of the certainties which we Germans, during 16 years of Merkel, tended to take as forever are evaporating before our eyes. The eternal assurance of the United States always protecting us, that's gone out with Donald Trump. The certainty that we will build an ever closer union, the EU, has gone out of the window with Brexit.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
For a long time, this economy has worked great for those at the very top. Ordinary, hardworking Americans, the people who built this country, have been basically cut out of the deal. And I've said this from the time I announced I was going to run. I believe this is a moment of potentially great change. This is our moment to deal working people back into the economy.
President Biden has some big plans. Senator Manchin is not coming along for the ride. This from Axios this morning. President Biden failing to persuade Senator Manchin to agree to spending $3.5 trillion on the budget reconciliation package during an Oval Office meeting on Wednesday. Down in D.C., our Washington correspondent, Bloomberg's Anne-Marie Hordern. Morning, Anne-Marie.
Good morning, John. Yeah, the president is still trying to get these moderate Democrats on board. He not only met with Senator Manchin, which the president also said, if you don't go along with this reconciliation, this could potentially put in jeopardy the hard infrastructure, that bipartisan infrastructure package. And it seemed like Senator Manchin just dug in and said, didn't care. That top line is just too big for him. It's also too big for Kyrsten Sinema. She also met with the president this week, and there are reports that she's running her own spreadsheets on where the top line should be. And this is where the division and the tension really lies right now in Washington. When the president made that speech yesterday, it was clear it was not just to everyday Americans, but it was to his own party. How are they going to get on board, the progressives and the moderates, in order to come up with reconciliation? Now, Jonathan, this week we've seen a a lot of House committees sign off on a number of legislation. It went to the Budget Committee. Next week, the Senate will start marking it up, and there's just going to be tons of negotiations between these two groups to try to come to an agreement. Timing is interesting because remember, Speaker Pelosi promised the House moderates that she will bring bipartisan infrastructure by September 27th. But the progressives say they will tank it unless they get reconciliation.
And then we've got the whole debt ceiling debate in between. Anne-Marie.
Exactly.
It's too much. Anne-Marie Holden, our Washington correspondent down in D.C. Back with us, Jim Karen, Wei Lee, Jay Pawlowski. Jim, I want to come to you on the bond market. It's this really, really interesting moment again where we debate the debt ceiling and I say, well, what do you do if things start to go wrong? And someone else says, well, I want to buy treasuries. Jim, does that change when things get bad? If things get bad over this, do we still buy treasuries?
Well, I mean, treasuries are always going to be a safe haven asset, very, very liquid, very high credit in quality, and it's going to be the place where people go to, particularly if credit or equity starts to falter. So there's no question about that. But on the way to this, it could be very, very messy. And that's why I said that there are a series of catalysts right now. It's almost like a perfect storm that's in front of us. This whole debate about infrastructure, this whole debate about the debt ceiling, this is never good for the markets. The markets don't like uncertainty, but they definitely do not like ambiguity. And where we are right now is in a period of ambiguity because we don't know how the debt ceiling debate's going to go. We think it gets resolved, but the path could be kind of strange. Infrastructure, we don't know how that's going to go either. So this is all ambiguous. It's not uncertainty that's hurting the market. This is ambiguity. Now we can price uncertainty. That's the volatility markets. That's something that we can do. You can't price ambiguity, and that's the issue right now that could weigh on the risk premium of broader assets, equity, credit, riskier bonds, all of the like. Yep. And this is what we're worried about, and this is what we see is in front of us over the next 6 weeks.
A bit of a little breakout in 10-year yields this morning, worth keeping an eye on. Out by 3 basis points now to 137. Got a bit of price action, back to 191 on 30s, up 2 basis points. Wei Lee, just your view on the debt ceiling debate. Is that a factor in your outlook at all?
Yes, it is, but we do not see that as a material risk. In fact, if you look at market reaction, they have been reasonably orderly compared with previous debt ceiling episode because of the very different growth environment and because of the very different liquidity environment that we're in right now. So in terms of our expectation for the debt ceiling discussion, odds of default, technical default, is really, really low in our expectation, in our view. There is risk of temporary government shutdown because time is of essence, but ultimately we still expect them to reach an agreement which would, I'm sorry, can you?
Jay Pawlowski, just a bit of a technical connection problem there with Wei Lee. We'll re-establish that connection. Jay, just first to you, sir, finally to you, final word on that, the debt ceiling debate, what it actually means from your perspective, if anything at all, because pretty much everyone we speak to right now, from a market's perspective, just willing to look right through it.
Yeah, I'm in the right through it camp too as well, John. And I think, look, higher rates are bullish for stocks. We're the segment that's already gone through a stealth correction. I expect the human capital plan to get passed via reconciliation. Democrats need to give President Biden a win after Afghanistan. And I believe we're in an era of big government where big government is going to drive change. COVID set the stage. Climate requires it. And I think we're going to set up for a CapEx boom that can leverage the developed market economies onto a higher growth path, which is very, very constructive, and very, very few people are talking about it.
You sound more bullish every time we talk. Looking forward to the conversation continuing through the opening bout. Jay Pawlowski, Jim Karen, Wei Lee, coming up, the morning calls, and later, Wall Street growing increasingly concerned about supply chain disruptions. A series of downgrades this week that we'll get our teeth into in just a moment. From New York City, this is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Friday morning, good morning. 5 minutes away from the opening bell. Futures unchanged on the S&P. On the Russell, down a little bit more than 0.1%. On the Nasdaq, we're down 0.08%. Yields with a bit of a lift. That curve steeper. What to look for going into the opening bell. That's the story with the price action. Let's get you some morning calls. First up, Jefferies downgrading Las Vegas Sands to a hold. The analyst questioning the casino's recovery amid tightening restrictions in Macau. That stock is positive this morning, at least, up 0.25% to 37.62. Your second call from UBS cutting its price target on FedEx to 380. The analyst expecting a decline in profits due to rising wages and a tightening labor market. That stock positive 0.2 to 258.88. And your third and final call from the team over at RBC Capital downgrading CSX to sector perform. The analyst seeing a lack of catalysts with supply disruptions raising a number of uncertainties. How many times have we heard that this week? That stock is down 1/10 to $30.88. Up next, a supply crunch gripping markets from tech to commodities. Across the labor market, that conversation just around the corner. The cash open this Friday to round out the trading week is next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
A looking to wrap up a really quiet trading week in this equity market. Good morning to you all this Friday morning. Here's the price action on the S&P 500. Down 4. We're negative about 0.1%. On the Nasdaq, we're down 23. We're negative about 0.1%. We're down 0.25% on the Russell. The small caps down 6. There's your opening bounce. Switch on the board and get to the bond market. 10-year yields look like this going into the Fed next week. Just a lift in the last 30 minutes or so. Up 3 basis points to 136.67. Curve steeper. Euro weaker, euro dollar 117.56. We're negative there 0.1%. Seen some dollar strength through periods of this week. Something to look for going into Chairman Powell's news conference on Wednesday. Full coverage on Bloomberg TV and on radio. The Fed decides. WTI, crude 71.81, negative 1.1%. We are down 80 cents. That is the cross-asset setup, your price action this Friday with your movers. Here's Abby.
John, well, that lift in yields that you were just outlining over the last 30 minutes or so with that 10-year yield now close to 137, it is helping out, not surprisingly, the big banks. We have the likes of JP Morgan, Citigroup, Bank of America, actually now flipping lower. They had been higher earlier in the pre-market. It seems that investors perhaps don't like that. That inflation threat not even helping the banks. Let's see, it might settle as the open goes on. But clearly pressuring big tech to some degree at this point. Microsoft and Apple both lower, and there we have the banks going higher. Something to watch as the day progresses, and certainly in this next half hour. Turning to the natural resources space, as you were mentioning, oil is under pressure. Take a look at some of the oil movers. They seem to not care going in the opposite direction, but steel now below $100 per ton and down nearly 80% from its recent peak. We can see some of those steel stocks. They are dropping here on the open, John.
How many times have we sold the open over the last week or so? Abby, thank you. Abigail Doolittle, 90 seconds into the session. The S&P down 0.2%. Energy, top of the pile. Abby on top of that story through the week. Energy advancing 0.6%. Little lift on the financials, up a little more than 0.1%. Yields higher, steeper curve, no doubt. Hurting, not hurting that particular trade. The story, though, hurting companies all around the world, supply constraints. We caught up with Cisco, the CEO, Chuck Robbins. Take a listen to this.
Our current view is that it will not begin to get better until at least into the middle part of next year. And it's still very fluid, so we're not even, we don't have a high degree of confidence on that yet.
That's Chuck Robbins. Demand story looks great. Supply constraints, Kaylee, they're going to persist.
Yeah, John, what Chuck Robbins just said actually echoes what we heard from Volkswagen yesterday that said they don't expect U.S. auto production to normalize until the second half of 2022. And just this morning, IHS Markit cut its auto production forecast for the year by 6.2% and for next year by 9.3%. It has been a tough go of it for auto companies lately as they can't match supply and demand because of that shortage of chips. But at the same time, all that demand for chips has given a lift to the companies that make them. That's why we see semiconductor stocks at a record, while GM, using it as a proxy for autos here, has started to lag. But it doesn't just stop at the chip crunch, John. There's kinks all throughout the supply chain, and we're seeing some serious bottlenecks in shipping and trade. Freight rates going absolutely through the roof through the course of 2021, and a big beneficiary of that is Maersk, which raised its full-year forecast as container rates have risen to records. That's not good for everyone, though, because that contributes to higher input costs. And what could that mean, John? Margin pressure. To this point, companies have been able to pass those costs through to their customers, but going forward, if these supply chain issues persist and margins are expected to contract, that could dent equity sentiment. Our very own Gina Martin Adams of Bloomberg Intelligence put together this chart, and it shows a number of years throughout the last decade where we've seen routes in the S&P 500 with a decline in margin forecast. Those lowering margin forecasts signaling fundamental weakness, and that ultimately hurt equity prices, John.
Kaylee, thank you. Thank you very much. Let's build on it. Wei Lee, Jim Karen, Jay Poloski still with us. Jay, factor all this into your outlook for margins on the S&P 500, for global margins for that matter, for some of these companies who are up against it right now. Demand, order book looks great. Supply's a problem.
No, I think you're right, John. I mean, part of the issue is that we are at record margins, and so therefore it's easy to assume that maybe they come down a little bit, and they might. But I think if you're constructive on growth, as I am, then you're constructive on earnings power. A little bit of inflation is actually constructive for margins. And I believe we are set up for a CapEx boom that could help drive productivity alongside higher margins in cap inflation. I think, to use the analog, John, I think we're going back to the 90s, the second half of the 90s, 1995 to 2000. And Pantheon Economics, not my idea, I give credit. Pantheon Economics out with a call on a CapEx boom. They said conditions are just about perfect. And when somebody says just about perfect, it's time to pay attention. So I think that's the setup, and I think we are completely positioned for it. We haven't had a CapEx boom in well over a decade or more. Companies are cash rich. Borrowing costs are super low.
Yeah.
Labor is tight. We need to invest in CapEx, and that can allow us to drive productivity and higher wages at the same time.